in his room has got this wild stuff. But we get everybody connected at different times, and my mom decides, I'm just ugly. You guys don't want to look at me. So then she holds her thing up and moon around. We're like, and finally my nephew goes, Grammy, we're just looking at the part of your hair.
Okay, can you fix that? Yeah, it gets interesting when you start doing those things. It's just,
Oh, who's got
I don't know.
who's HR? Jenna.
I'm trying to figure you out,
I
Jenna.
was using, we had our HR meeting and we were supposed to put like the funniest background. So that was mine.
Oh. It was pretty interesting. I like your kitchen there. Oh.
We had to do a Zoom meeting last week, and one of the ladies had Hawaii in the background.
Uh-huh.
So we're like, we wish we were there. Why are we here?
Yeah. Oh, George is going to put the class stuff up already.
He's ready to go.
That's right.
I don't have my watch. What time is it?
We have 2 more minutes.
Yeah. But yeah, so it's always fun. After we had our Zoom meeting, our family one last week, my sister posted this hilarious picture about the Brady Bunch that was just perfect for describing our meeting with my mom. And so she's getting better. She's getting better.
My parents crack me up because every time they have an IT question, I help them and it works. And then a day later, they're like, you know what you did the other day? It doesn't work anymore.
That's what we write very explicit instructions for my mom. If she needs anything, she calls me and says, here's my credit card number, buy it. And so when her internet went out, they sent her a new modem and told her she needed to hook it up. So she calls me and explaining the wires. I'm like, Mom, I can't see the wires. I don't know what you're doing. I cannot help you from here.
Oh, that's hilarious. Yeah, I've gotten those calls too, but it's so funny because I fix it and then a couple of days later it's broken again. I'm like, what did you guys do?
Yeah.
They're like, we don't know. We didn't even touch it. I'm like, well.
Yeah. Yeah, my mom goes, I just turned it off and you guys have to come up here for the weekend.
Oh, there you go. Does she live close?
She lives up in Rancho Murieta.
Oh, okay.
So it's 72 miles, not that I haven't driven it a million times.
Hey, Donna.
Yeah.
So I was about to email Reem, and I stopped myself because I said, wait a minute, I don't understand. You can't submit everything earlier than her deadline? Or what's the issue exactly? Because she's dragging it out.
The last night is our presentations.
Okay. I didn't have that piece of information in my mind.
Yeah.
Okay. Let me get back to her then.
Okay. So in our group, I didn't know it was just me or everybody, but I was just like excessively stressed on trying to figure out what to do on between our project and everything. So we asked her if we could have class Wednesday night. So she's actually going to have a class with us Wednesday night because everybody's feeling very lost.
Okay, well at least that's one step in the right direction. Okay, yeah. I'm glad to hear that. But I'll nudge her about that. I told her not to push anything out into May. I said it's the worst idea in the world because you have other classes. Well, I mean nobody's going anywhere, but you want a break and
yeah, I'd like 1 week break between classes.
Yeah, right. And just because we started late doesn't mean you guys should suffer. That's not your fault. So.
Well, and what was kind of interesting is in the beginning, she wasn't going to meet that first week. And so she originally had our plan to be only 6 weeks. And then when she redid the syllabus, she did it over 7 weeks.
Right. Yeah. And then that too, which was very strange. And I thought she was going to have classes like we're doing, but
yeah.
Not. So, okay. Well, I'll deal with it. Well, it is the 6 o'clock hour. Welcome everybody to the show. What I wanted to tell you was a couple of housekeeping things. One was that I have the videos up for weeks 1, 2, and 3 now. They always take forever because YouTube doesn't want to render the video. Like I have to try different things to get YouTube to render the videos, but I finally figured it out. So that these should happen a lot quicker if you happen to need the videos at all. But the links are in the announcement section as usual. Okay, so that's number one. Number two is I just want to recognize the fact that this is session 4, yeah. We're basically at the halfway point. Not even basically, exactly at the halfway point. And tonight is kind of a transition night in 2 ways. One way is on the economic side of things. We're going to switch focus completely from micro to macro economics. And on the statistical side of things, it's going to be getting knee deep into the actual statistical testing procedures. We've kind of set the stage for that over the last few weeks, and now we're going to go feet first into actually doing them. So, you'll see kind of not a huge change, but a noticeable change tonight from the direction we were headed in the last few weeks, and it should all seg together nicely. So let's just get started then. Thumbs up, you see my gross domestic product slide? Good, all right. Cool, so that's exactly what we're gonna talk about. And we've had some discussions already, which is nice because we've brought this concept up before. We're kind of primed for it, and it's a hyper important concept nowadays because of everything going on with the pandemic, and this quantity that we're gonna study ad nauseum here is gonna be drastically affected, as you know. So let me just take you into the specifics. So I'm not going to keep saying gross domestic product because that's a mouthful. GDP, and when you turn on the news, you hear GDP all the time. So what is this mysterious number? Well, if you want to summarize it in one word, because you like things easy, right? Go down to my second bullet point and just hang on this word right here: production. GDP is basically a measure of production. Now, how you measure that production, that's what we're going to spend the bulk of time talking about, because we want you to know the components of GDP. But essentially, at the end of the day, GDP is a measure of how much a country or a region doesn't, you can really look at GDP for any size producing. Okay, so the second way to think about GDP by way of introduction is back to my first bullet point, the final market value of goods and services produced in a body like a country. We'll talk about US GDP mostly. So the important phrase there is market value. And that is very simply what something sells for in the final stage of its sales pathway, if you will. Okay, so hold on to that thought. I'm going to keep going. So we have to understand the difference between final goods and services and intermediate goods and services, and it's a pretty easy distinction. Think about like your car. You bought a car probably at some point in your life, and the car that you purchased was the final good. Okay, because what happened before you bought the car was the car manufacturer bought wheels and dashboards and all these parts and pieces, and they assembled them together. And all those parts and pieces were bought from other companies. So if we're Toyota, we buy the dashboards from this company, we buy the wheels from that company. Maybe they make a few things, but the point is those are all intermediate goods because they're not the final sale of the car to you. So that's the distinction, is the thing that we're buying going into something else for a final sale. In that case, it's an intermediate good or service, and it's not counted in GDP. The only thing we count in GDP is final goods or services. So the car you bought, the haircut you wish you could get nowadays. Think about services, right? Services, basically most services are final that you know of, that you think of on a daily routine. So just understand that the GDP doesn't look at every single facet of production in one respect, but in another respect it does, because we're summarizing all those different productions across the supply chain in that final market price, which include, remember, final market prices, the price you paid for your car, includes markups for all the other players that had a hand in making that car. And you give them your $25,000 or whatever, and that price represents, again, payment to all these different intermediaries. Okay. The other thing is that There are, household services. So you live with your partner and your partner makes you dinner. Okay, does that get counted in GDP? No, because there's no recordable transaction. But when you go out to eat at Applebee's or wherever you go, that gets recorded because that's actual transaction. So black market activity, which sounds like it's a bad thing, but there's plenty of good black market activity, like your partner making you dinner. That's not counted in GDP. And so what we're really saying here is that GDP is underestimated. The actual GDP, if we could get our hands on all this data about what's happening in the black market, then that would be a higher calculation of GDP than the one that you normally see. Okay, so let's keep going. Now, we get specific. You're going to hear this term circular flows. What this means is in any economy, especially the US economy, money changes hands and it kind of goes around in a circle because you pay someone else and then they pay someone else, and then sooner or later that money kind of comes back to you because you're part of a system. Okay, so that's what we mean by circular flows. Money doesn't, money doesn't get spent and go into a vacuum. It circulates throughout an economy, and not everything, not every single dollar you spend comes back to you, obviously, but a portion of it does. And that's what we mean by circular flow in the economy. Okay, so part of those circular flows and everything which makes up GDP is summarized right here. You have consumption expenditures, which we're going to label C for short. And that's the one that you know best. That's all the stuff that you buy from the grocery store, from Amazon, wherever you shop. Okay, consumption expenditure, consumers, you and I, spending on goods and services. Again, final goods only. And that's the only thing we buy anyway, unless we're in business, right? Number two, investment, abbreviated I. Okay, this is buying big capital equipment, like big machines, buildings, construction, that kind of stuff. Okay, and then the one that sneaks in there that's not as obvious is inventories. And anything that's investment is done by businesses. That's the thing you need to understand about investments. Consumption, C, is consumers. Investment, I, is done by businesses. And businesses buy big things like buildings and machines. And they also build up inventories. Okay, so inventories gets counted as part of investment, and a lot of people forget that. And you'll see that on some of your problems too. The next one is government expenditure. That's exactly what it sounds like. Government spends money on things like defense, like social service programs, unemployment, all the stuff going on right now. Government's ramping up to spend a lot of money, right? So that's G. And G can be, like C type of expenditures or I types of expenditures. But the point is, whatever expenditure it is, it's done by the government. Whereas I is done by businesses and C is done by ordinary consumers. The last one, the last component of GDP is net exports. So we have exports and we have imports. If you subtract the two, exports minus imports, you have what's called net exports. And that number can be positive or negative. It's positive if your exports exceed your imports. It's negative if your imports exceed your exports. We'll come back to this later, but most big economies, successful economies, tend to have more imports than exports. And we'll talk about whether that's a good thing or not later. So that number tends to be negative because your imports are higher than exports. Okay, so those are your four components of GDP. All you do basically is, I'm going to skip right down to the bottom, you add them all up, C plus I plus G plus NX, and that gives you total expenditure. And, I see my video. I'm looking at my video, it froze. I hate that. Why does that happen? You know what, I'm going to stop I don't like looking at myself like that, neither do you. So I'm going to see if I can restart my video. Stop video, start video. Okay, there we are. What?
You can see you normally again.
Yes, that was the goal. But the problem is I'm not really normal. So whatever you're seeing in any respect is never going to be normal. But that's not for you to worry about. All right. So, and if, by the way, if that happens again, just scream at me and say, "Hey, Jordan, you're freezing," so that I don't have to, or so that I know that I have to fix it. Okay, so total expenditure is C plus I plus G plus NX. I think that's pretty simple to understand. And then we take it a step further. And we talk about what happens to households or with households, and this thing called household income. Well, income you understand. Income is money that you make for doing something, right? And so in macroeconomics, we like to talk about the factors of production. And the factors of production are the things that produce, basically. Okay, so you and I supply labor to the labor markets. So labor is a factor of production. Capital, money, that can be invested in businesses and in investment instruments. That's another factor of production. So capital, to simplify it, we're being very simple here because you have interest and dividends and then everything in between, but capital essentially earns some kind of interest. Land is another factor of production. If you've got more land, you've got a higher degree of factor of production, and land earns rent if you're able to rent it out. And then the last one is entrepreneurship, which is kind of like a form of labor, but it's a special form of labor because it gets businesses started. And so what do entrepreneurs earn? Well, most of the time they lose money, but a few of them are successful and earn profits, okay? And so where all this earning goes eventually, if you follow the circular flow diagrams, is it all eventually goes to households, okay? Because, think about it. Labor, okay, that makes sense. You earn a paycheck, that's your household. You earn interest on capital. Well, what do you do with the interest? Eventually, it goes in your bank account. Even if the government earns interest, that's some of it at least is going to end up in your pocket sooner or later through some means. Land earns rent. That's, somebody owns the land. So that money goes into their household pocket. And then entrepreneurship, you get dividends, you cash out of the business, you get a salary, et cetera. So the salary would go in the labor part, but the profit, you understand, then goes back to the entrepreneur. So at the end of the day, whatever the factors of production earn, it all eventually goes back into the household income. And now we kind of pull a fast one on you and we equate two quantities that you might not think of equating. We say that the sum total of all the income earned by the factors of production is going to be the same thing as total expenditures or GDP. So total expenditures, GDP, income, they're all the same thing. And that's what I wrote here in the bottom bullet point. So what you can do is say that Y equals C plus I plus G plus NX. Y is traditionally income in macroeconomic lingo. Don't ask me why they picked Y. Actually, I know why they picked Y, because I was already taken for investment. So Y is income. But this whole thing, furthermore, equals gross domestic product because the value of production at market prices is the same thing as all of the incomes that we listed here. If you just trace all of the flows, just trust me on this one. It's not intuitive initially, but it does make sense. The money has to go somewhere, right? We produce stuff. Where does all the money go for the production that we get? It goes into household income. So that's why these two quantities are the same. So then it turns out, because you have two ways of calculating the same thing, GDP, we can choose which method we want to use to calculate GDP. And we'll start with the expenditure approach, which is everything we already talked about. Look down at the chart. And this is information for 2016, which had things not gone so haywire lately with the pandemic, the numbers would have looked pretty close to what you're seeing here, because 2016 was a good year and 2020 was shaping up to be a good year till everything went down. But here's what you notice immediately. C is huge. It's the biggest component of GDP, 68%, almost 69%. Okay, more than 2/3 of GDP is consumption expenditures. And then investment and government expenditure, roughly the same, give or take a few percentage points. They're basically tied. But they're both much smaller than consumption expenditure. So, governments spend money, and the amount of money governments spend has a lot to do with who's in office. And, Democrats spend more, Republicans spend less, but not always. There are exceptions. But the point is, whatever gets spent, it's small in comparison to what you and I spend as consumers. Okay. And then also small compared to what businesses spend as investment. You wouldn't think that because, you think about businesses and you're dealing in millions and billions of dollars. But you and I as consumers are doing most of the spending. Now, look at another weird thing here. Net exports is negative. And as I said before, that's usually the case with developed economies. They're going to wind up importing more than they export. And that gets into a discussion about comparative and absolute advantage, which we will hold off on until we get to the international piece. But it's negative here, and that's no shocker. And then the whole thing sums up to some big number, 18 trillion, I guess this would be. And that's our GDP for the first quarter of 2016, right? So GDP gets calculated by quarter, by month, by year. You wouldn't add it past a year. You wouldn't say this is like a 2-year GDP. That doesn't make sense. The most you're going to have is a yearly GDP calculation. Okay. So I kind of said this before, but a little kind of fine tuning here about what goes into that GDP number. Used goods, so stuff you buy on eBay that was already produced and bought by somebody else doesn't get included in GDP because it was included in GDP the first time it was sold. And then when we buy financial assets, you invest in a stock or a bond, you're not buying production. Okay, when you buy your car, you bought something that's produced. When you buy a hamburger, same deal. When you buy a stock or a bond, you're buying a right to accrue dividends and possibly capital appreciation in a company or interest, and that's not production. Remember again, GDP can be summarized in one simple word: production. How much production do we have? What's the value of production? So that's why you understand these things don't get counted. Okay, method number 2 then, you can use the expenditure approach, you can use the income approach. And now we're going to look at, under the income approach, what are all the incomes and how much are they and what do they add up to, with some adjustments, and you'll see why. So we start with what's called the U.S. National Income and Product Account, which has 2 kinds of income in there. It's got the wage income and it's got interest, rent, and profit income. Which lines up nicely with the slide we presented before about all the different kinds of household income. So let's go through each one a little bit more in depth here. This one you understand perfectly. You all earn wages. So when you get compensated from your job, that's called wage income, and it includes wage or salary, and then all the other stuff that employers pay you, like benefits, the value of those benefits, healthcare insurance, what gets paid in for Social Security, pension contributions, all that other extra stuff that you see in your paycheck or sometimes don't see because they just spend on it and you get the benefit. But the dollar value of all that goes into wage income. The rest of this is almost self-explanatory. Interest, rent, and profit, collectively called net operating surplus. Don't ask me why they chose that term, but they use it to distinguish it from the wage income that we just covered. But if you think about the bare essential, what's going on here is it's income earned by your factors of production other than labor, right? So capital, land, and entrepreneurship. We said before, interest is earned on capital, rent is earned on land sometimes, and then profit is what entrepreneurs make. So all of those incomes, or losses, by the way, profit can be lost too. If businesses lose, it subtracts from GDP. Okay, so don't assume that it's always a positive number in that profit component. But if we add all those up, you have something like you see here, again, for that first quarter of 2016. And, again, the numbers would look similar today if, things hadn't gone down with the pandemic, where wages would be a factor greater than the net operating surplus income. So here it's about double the 4,500. You've got, roughly 998 or 10,000. And that's, again, wages are the major source of income here, not the net operating surplus as you might expect. And then you can break it down in percentages, 54 versus 25. These numbers are not going to fluctuate hugely when you have essentially the same economic conditions over, say, 5 years. It's going to pretty much be the same breakdown. Now, the problem is that's not a final answer on the income side. If we really actually want to continue to try to calculate GDP based on income, we actually have to make some adjustments. Okay, so I say here, net domestic product, which is what we figured out here, right? The bottom line is not GDP. We have to make two adjustments to arrive at GDP from, again, this bottom line number here. Okay, and so the first adjustment is adjusting factor cost to market prices, because nothing is stated in market prices. We talk about labor and profits and all that. And then there's another adjustment called net product to gross product. And this will drive you crazy, the terminology, but it turns out mathematically it's very simple when you see the formula. Okay, so let's just kind of go through the first piece here. Is the adjustment of factor costs, which we already calculated, to market prices. So what's the problem? Again, nothing is stated in market prices. GDP is by definition stated in market prices. So one of the obstacles to doing that is that you don't have this thing called indirect taxes summed up in the factor cost that you calculated. So what you do is you take indirect taxes, and I don't know the full list of indirect taxes. I know one of them is sales tax, but there are others, and you don't have to worry about what they are until you work for the BEPR or the government, right? But whatever those taxes are, those get added back into factor cost. So that's step one. And then subsidies. What's a subsidy? A subsidy is when a government pays a firm to basically keep it alive and producing, okay, which I think is going to happen pretty soon with the milk and meat markets here. I don't know if you're reading the papers, but we're dumping milk and meat, and part of it's the contamination from Corona. The other part of it is nobody's buying because the hotels and the schools aren't buying milk, right? Who buys milk? Schools all across the country. Well, schools are closed. You don't need to serve milk. So yeah, you're doing it at home, but not in the same volume you were doing it in the school. So anyway, what's going to start happening, as has happened in the past, is the government's going to subsidize those industries, which literally means they're going to give money to keep those businesses alive. Farmers get subsidies all the time too. We talked about that before with price controls. So the subsidy is not production. That's the thing. If you account for the subsidy income that these businesses get, then you're basically overstating production, because the subsidy is a gift from the government to the farmer or the rancher or whoever. So what you have to do from a calculation standpoint is pull it out. So the bottom bullet point there, add indirect taxes, and then pull out or subtract your subsidies, and that takes you one step further towards calculating GDP. Step two is what's called the adjustment from net to gross product, and this has to do with depreciation. Depreciation, if you don't know, is a charge that you take. It's basically an expense that reflects the amount of value that you're losing in your equipment, like your machines and your buildings, over time, because they're getting worn out, right? They have a usage life cycle. So when we look at profits in the expenditure approach for GDP calculation, depreciation has been subtracted. Okay, so you have the net profit. Let me back up again. I'm confusing myself here. In the income approach, one of the incomes was profits. Sorry. Okay, and in profit, the depreciation was subtracted out. That's just the way the accounting gets done. So what you need to do if you're using the income approach is you have to put that expense back in. So whatever that depreciation was that was subtracted out of the firm's profits, now we add it back in, so it's kind of like a wash. Okay? And that's basically what this slide is saying in too many words. But it's very simple. Calculation-wise, there's only three things, right? You're adding indirect taxes, you're subtracting subsidies, and then you're adding back depreciation. And that leads you to this endpoint, which is now you have the GDP calculated on the income approach. So let's review. The first thing we did was we got to the net domestic product at factor cost, which was summing wages and net operating surplus. That gives us the 14,000 and change. Or really it's 14 trillion, but I'm lopping off the zeros. And then you take indirect taxes less subsidies. So basically you're adding indirect taxes, you're subtracting subsidies. The net of those two reported together is this number. And then you're adding back in depreciation, which is this number. So 1 + 2 + 3 equals this number, and that's your GDP, okay, under the income approach, which is pretty darn close to the GDP under the expenditure approach, but there is a little bit of a difference, and that's what leads us to this next slide called statistical discrepancy. So, you know, in accounting, nothing ever balances, especially when you're dealing with these big numbers and all these different inputs. So you would expect there's going to be a difference in the totals that you get, and the difference is called statistical discrepancy. Okay, and it's very simple. It's just, again, the difference between GDP calculated under expenditure method versus income method. Whatever that difference is your discrepancy, and you'll always have one. The question is how big is it? So let's take a look. In this case, the GDP under income approach we just calculated was 18,550 right here. And then sorry for the cross out because this number was wrong and I couldn't change the chart without just crossing it out. But the GDP under the expenditure approach a few slides back was 18,282. So you have a difference of 268, okay? And that is your statistical discrepancy. What do I do about that? Hopefully you try to get that number down as small as you can get it. Now, think about it, you know, 268 relative to 18,000, it's not nothing, but it's not a huge number. So here we're pretty fortunate. If this number was more like 5,000, 6,000, then we get a couple of gray hairs if we're working for the government and trying to figure out GDP, because then your two methods are not working basically in tandem. Okay, but here it's, you know, little bits and pieces here of difference. And so you might take an average of these two. You might just trust one versus the other. There's all sorts of subjective judgment calls you can make depending on how big this number is, or you might try to force these to be closer to each other just by redoing your data. But it's a subjective judgment call, and realize that it happens again because we have two methods of calculation. And hopefully, again, this number is small. It's 1.5% of GDP. So it's not trivial, but it's not huge either at the same time. Okay, so now you know the two methods for calculating GDP. You know, of course, we simplified it when you actually do it. There's subtotals among subtotals, and it's a lot of work, and you have tons of people working on it, but you just saw the bare essentials, and that's all we really need to do in this course. Let's also talk about this other concept that if you were to take economics, say 20, 30 years ago, everybody was talking about GNP, not GDP. Somehow there was a switch in focus from GNP to GDP, and I don't understand why that's the case. If anything, it should have been the other way around once you understand what GNP is. So let's just go right to the definition. Any country's GNP, but we'll talk about the US GNP, is its GDP plus any factor income from abroad. So what am I saying here? The reason why it's called gross domestic product, D for domestic, is because it only accounts for what's produced here on our soil in America, or whatever country you're doing the calculation for, it's their soil. Okay, but what happens when an American company goes abroad, or an entrepreneur goes abroad and starts making stuff in France or Africa or wherever, and then that money somehow goes, whatever money you make somehow goes back to the US? Well, if you're calculating GNP, then that money is going to get counted in that value of production is going to get counted in GNP. But if you're just looking at GDP, then we basically ignore whatever factor income is made from abroad. Okay, and why did I say that it doesn't make sense to me that the focus went from GNP to GDP is because we're more of a global economy now than we were Again, pandemic issues aside, before all this all happened, we were a bustling global economy, even though we got more protectionist. But, for the last 20, 30 years, everything's been international. We sell to each other, we trade. And it's only gotten more and more over the years. So why are we looking at just GDP? I don't get it. It should have been the other way around. So understand the distinction, understand in Jordan's opinion, it's the wrong move. Maybe you have your own opinion, and we'll get to that for sure. Okay. Now, another concept we want you to understand fully, and you're going to see this come back to affect a lot of measures, not just GDP. This distinction between real and nominal, very, very important in macroeconomics. The problem with most measures, if you just take a measure, say, of market prices of goods produced, is that prices change over time because of inflation, right? You have inflation most of the time. Some of the time you have deflation, which means prices are going down. And I think you're going to start to see deflation now in this economy with everything going on. But the point is, whatever direction prices are going, they kind of throw a wrench into the analysis of GDP over time. And we would want to know, is GDP increasing because we're producing more, or is it increasing or decreasing just because prices are changing? Okay. Again, what's the whole idea behind GDP? Figure out how much production we're doing in a country or in a certain society. So when you put prices into the mix, which you do automatically when you take these measures, the pricing can screw the measures up. So the solution is to take the pricing effects out of the measures and report this thing called real GDP. Okay, so that brings up the distinction between nominal GDP and real GDP. Nominal is just literally the actual measure of GDP. You bought your car for $25,000, you bought your hamburger for $5. So if those are the only two things within a one-person economy, then the GDP that period would be $25,000 plus $5, or 25,000 and $5. But now we want to deflate that measure by the real. We want to find the real component of that nominal GDP, and that means we have to express the production and the prices in base year terms. And a base year is some year that we use the prices for products consistently throughout our entire analysis of GDP. Okay, so the next slide, we're going to show you exactly what that means. But the choice of base year is somewhat arbitrary. However, there are better versus worse ways to pick what that base year should be. And so we'll get into that more when we deal with inflation. I just want you to understand that there's this concept called base year, and it's very important in trying to figure out anything real, any real measure, whether it's GDP or any other measure we're going to discuss in the course. So what's the goal again? Real GDP is really what we want to focus on. You don't ever focus on nominal GDP because it's got inflation or deflation affecting the result. So when economists talk about GDP, they're talking 99% of the time about real GDP, which is GDP adjusted for price changes. So let's look at an example. We're going to make things simple. We have the C plus I plus G plus Y setup, which you know already is GDP. Total expenditure, GDP, income, but really we're just going to call it GDP because that's what we care about. And there's basically three, oh, by the way, they left off net exports here, so it's just three components out of the usual four, but that's okay because net exports gets too tricky to talk about in this context. But we're only making three things: t-shirts, computer chips, and security services, right? And here's how many of those we sold in 2009. Here was the price per unit. So if you just do the multiplication, here is the expenditure, and it's a nice round $100 in 2009. Now, let's pretend go back 4 years, we're in 2016, and we want to do the same thing, talk about the t-shirts, the computer chips, the security services that were produced that year and purchased. So the quantities change because quantities always change. Things become more popular or less popular over the years. The prices change, of course. So you'll notice these prices do not correspond to these prices. Everything, these two doubled basically in price. This one stayed the same. But now you multiply out, and here's the total expenditure in 2016, or the total GDP in nominal terms here and here. 300 versus 100. Nominal GDP, nominal GDP. Okay, so it would seem right off the bat that your production tripled in this economy. It went from a nominal of 100 GDP to 300 GDP, but you know already that that's not the case. And what happened basically was GDP went up a lot because of the increase in price. So we have to factor out the increase in price, and the way you do it is you recalculate your whole 2016 based on the base year prices, which means I'm just going to look at the 2009 prices and carry them down. So look what I did. 5, 10, 20 gets carried down here, 5, 10, 20. I keep the 2016 quantities because that shouldn't change from 2016. So I multiply the 2016 quantities by the base year prices for those quantities, and now I have a real GDP. This should say 2016. That's a typo, sorry. Of $160, not 300. So production went up about 60%, from 100 to 160. Not it didn't triple, 300%, okay, or 200% times plus the initial. So that's the idea of real GDP. And again, everything gets quoted by economists in real terms because you can't trust pricing, because prices change over time. So we're going to come back to this concept again and again and again when we talk about inflation, unemployment, real versus nominal. Almost always, real is the number you want to focus on because it tells you the true story of what's going on. Okay, so what do we do with this GDP measure? 3 things here. I mean, it's not an exhaustive list, but it's a pretty good one to start. We're going to use it to compare standard of living over time in a single place. Okay, so like the US standard of living, did it go up or down over the years? You can compare 2 countries' standards of living, both at a point in time and then across time. And then we use it to track the course of the business cycle. Are we having a recession, an expansion? We're going to use GDP to help us figure that out. Okay, and so one measure we'll default to, and we'll talk more about it in the next module, is real GDP per person, or you might have heard GDP per capita, is the measure that gets used to compare standards of living. So more on that in a few slides. And then if you're comparing across countries, it's not as simple as just using that real GDP per person. You have to look at another thing called purchasing power parity, which takes into account exchange rates, because exchange rates can screw up the analyses just like prices can, because essentially an exchange rate is a price for a currency. So more on that later. Let's look at an example here. Okay, in 2016, the U.S. real GDP was 18,282 billion. That's basically 18 trillion, I think. And we also have to look at the population, how many people were alive, and it happened to be 325 and change million, okay? So what you do to figure out real GDP per person is you just divide those 2 numbers. Take the GDP and divide it through by the population, and then your answer is 56,200. And so that should look like kind of like an average salary. Okay, you know, for the Bay Area, that would be low. But for, I don't know, Alabama and some parts of the Midwest, that's might even be high for a person on average. So, but the point I'm making is it should, you know, when you figure out your GDP per person, it should start to look on the level of a salary. And that's what you're getting here, okay? Now, compare the GDP per person in real terms in 2016 with what it was in 1960. And the conclusion you come to is that we basically tripled the standard of living between 1960 and 2016. by using this GDP per person measure. It's a very, very important measure of standard of living, okay? It's not the only measure, and we're going to argue why it's sometimes a faulty measure coming up, but it's one that gets certainly used as a starting point. Okay, moving on then. We're going to come back to that idea in the next module when we talk about economic growth, but you have the next concept is real versus potential GDP. And I will tell you off the bat, it took me a while to understand what potential GDP is because it's not really a real number in the sense that you can calculate it with hard data, okay? What potential GDP is a projection of what GDP should be if we're fully employing our factors, all the factors of production, labor, capital, land, entrepreneurship, okay? So, you know, you always hear the comment, are you reaching your potential, right? It's the same thing with GDP. Are we reaching the height of the GDP that we could be if everything was employed the way it should be? And so when you have unemployed or underemployed factors of production, then the real GDP that you wind up calculating is less than the potential GDP that you could have, because basically your resources are on the shelf sitting there doing nothing, right? So for instance, now, you know, nobody's going anywhere. So you have that car sitting in the garage most of the week. So, you know, if you were using your car before to do Uber, if you were an Uber driver, now you're not using it. So that factor is underemployed now. And therefore, potential GDP is going to be way lower than, real GDP is going to be way lower than what the potential could be if that car was used like it was before, okay? Same thing goes with just working, right? If you have unemployment, what happens? Your real GDP is less than potential GDP. So the potential GDP is a nice number to look at when we, you know, talk about how good an economy could be, but it's still a fabrication because it's not based on hard facts of, you know, what actually happened. It's based on what we think could happen if everybody did what we wanted them to do in terms of factors of production. And then the second thing is, if you see the bottom bullet point here, if we're trying to measure the trend in standard of living, we don't want to focus on short-term fluctuations in real GDP. We want to actually use that potential GDP number. So let's look at a chart that kind of illustrates that. If you look, this is from 1960 to 2020, projected, of course, 2020. And you have two lines here. The orange line, which is real GDP per person. And then you have the black line, which is the potential GDP per person, okay, or per capita. And you see that the lines basically hug each other, but the orange line goes above here, above, below. It kind of does like a sine curve thing across the black line. And so that's really, you know, cutting out the fluctuations that we talked about before. When economists are evaluating an economy, they don't want to think about this point and or this point and this point. Those peaks and troughs are a little bit misleading. What's more interesting and more useful is following the major trend line that smooths out the peaks and troughs, and that's your potential GDP per person. Again, it's a projection kind of a number. It's not actual fact of what happened. Now, point number two this chart makes is look at, you know, the different time spans. 1960 to about 1970, the growth rate was 2.9% in real GDP per person. So that was the best we ever did, was up until the early 70s. And then it started slowing down, okay? From 70 to 2007, that's a long stretch of time. From here all the way to about here, we still had GDP growth per person, but it slowed to 2.1% on average per year. Okay, and then the worst news of it all was after 2007, up until about now, and now it's, I don't even want to think about what's happening now, but let's say up until the beginning of the year, the growth even slowed further to 0.5%. So the general trend of real GDP over time has been decreasing increases. That's the best way to put it, okay? And why that's happening, that it's anybody's theory. You would think that with technology and automation, artificial intelligence, you might have seen the opposite result, which is increases. But in fact, you've seen decreases in the rate of increase over time. So that's a topic of discussion that we could talk about till we're blue in the face, and different economists have different opinions about why that's the case. But just wanted you to know that's the case. Then you can have your theories about it, right? The other use we talked about was business cycle. This is what, even when you don't take an economics course, you hear about this all the time, and you know about this, right? We have recessions, we have depressions, God forbid, we have expansions, okay? And so you're just following the actual real GDP result here in blue. And when the line is going up over time, it's an expansion. It hits a peak, and then it starts declining, not in a straight line fashion. It declines and it goes up again and it declines, but the general trend here is down. And then it hits a bottom point called a trough, and then it expands again, not in a linear fashion. And those are the 4 stages of your business cycle, right? You have expansion, peak, recession, and trough. So the part shaded in pink here is a recession, because the GDP growth, and by the way, we're looking at real GDP in total, not per person here. The official measure of whether we have a recession or an expansion is calculated using real GDP, plain real GDP, not GDP per person, okay? But notice it's real GDP, not nominal GDP. Nobody uses nominal GDP because it's useless. So this pink section, you're seeing a decline in GDP for about a year and a half, 2 years. The hard and fast, I'm sorry, not the hard and fast, the rule, the vague rule that economists follow, and really more specifically, it's National Bureau of Economic Research, NBER. The rule that they have set up and the rule they follow is they declare a recession when GDP growth rate is negative for 6 months or more. Okay, so this is the full year of 2008 and part of 2009. So that's clearly more than 6 months. But the official line of demarcation is 6 months. 6 months of decline in GDP, real GDP, is considered a recession. Now, I kind of stole my own thunder. Is this a hard and fast rule? Well, for the NBER it is. For other economists, they might say, no, it takes a year. Because, you could have a 6 month decline and it's just tied to some kind of obstacle like, the pandemic, right? Or it could just be that you had bad weather conditions in a major producing region of the country, but that's going to reverse. Maybe it's a drought or something like that. So 6 months might not be long enough to really say what's going on in an economy. So there's a school of thought that says 6 months is too short a time frame. Okay, but in America, and you see what's going on in politics now with the pandemic, what do we want to do? We want to reopen the economy, right? Because if we're declining in GDP for too long, then everybody's lives are going to get affected negatively, right? People lose jobs, people can't buy what they need, the economy sputters because they're intertwined, right? If I can't buy unless I have a job, there's no jobs unless people are buying. So we're kind of anxious. We don't want it to last that long. We don't want to wait until there's till there's a year, 12 months, 13 months, 14 months to declare a recession. We want to declare or nip it in the bud, basically. So the way you do that is you shorten the time frame needed to declare a recession. And the shortest time frame, according to the majority of economists, is 6 months. Okay, so that's again why. First of all, it's not a hard and a fast rule, but number two, why is it wind up being 6 months? Because we don't want to wait too long. We want to start doing something about it, and you can't do something about it until you know that you have it. And so that's the problem. Okay. Now, in addition to disagreement about what actually constitutes a recession, again, the formal definition being 6 months of decline in real GDP, there is a lot of debate about whether GDP is really an adequate measure of an economy's success. Okay, so remember again, what does GDP measure? Production. Well, is production always a good thing? No. Think about like pollution, right? You produce stuff and you pollute the environment. So why isn't there a measure of pollution included in GDP? Well, there isn't. And look at all these other things here, all these different points. We don't capture how much leisure time we have. Okay, so we could be producing like crazy, but everybody's, tired and sick because we're working too hard. So what good is the production? I don't think it's good at all. And it's a problem that we have. It's not unique to the United States, but the United States is one of these economies where we think we should be working all the time because everybody wants to try to make a couple of $1 million, if not $1 billion. And that's okay. It's part of the culture. But now you have a backlash against that where people are saying, no, we want to have more leisure time. We want to kind of breathe. We want to enjoy life. So and by the way, who does all the spoils go to? It doesn't go to me necessarily. So why am I working so hard anyway? So leisure time, I talked about pollution, environmental quality, what another nickname for that is the triple bottom line you might have heard, right? Planet, people, and profit at the same time. We have to care about all three. Living conditions. When you have a good economy, look at the Bay Area. I mean, I think Tracy's even worse. I've been driven home from Tracy back to the Bay Area several times. You don't want to be on, Route 205 and 580 past 9 o'clock. It's a total disaster. Okay. But we all have bad traffic. So the point is, okay, we're doing well here in the Bay Area and Tracy economies, but we suffer every time we have to get in the car. Okay, we suffer when we want to go shopping because, pandemic aside, there's too many people living here. We're too crowded together, and that leads to other problems. So what good is the production if we have to live like this, right? So that's another way to look at GDP is a poor measure of success. Health, this all ties in together. Everything's interrelated, right? The longevity is going down in the U.S. We're actually living fewer numbers of days as time goes on because of things like pollution and stress and inequality. Okay, whereas other economies are going the opposite direction. Again, pandemic aside, they're getting longer lives, more longevity. We're going down, so we're not doing a good job there. Happiness, are you happy, right? This all ties together. Everything here is interrelated. Otherwise known as social well-being is a kind of a broader concept of happiness. You don't have to be happy every waking moment of the day, but the question is, are you experiencing social well-being? And then freedom, can I say what I want in this economy? Can I form my own political party if I wanted to? Can I speak out against politicians? Am I socially free? All the different kinds of freedoms that you can have, economic freedom, et cetera, that gets affected by what we do in an economy, and GDP doesn't capture that level of performance, basically. And then the last one I kind of mentioned already, economic equality, that's a topic unto itself. So that's essentially, as we do better, meaning more and more GDP growth, the inequality gets worse and worse and worse in the US. Okay, so you have, like the haves and the have-nots, and the wedge gets bigger and bigger as our GDP goes up. So what good is the GDP if that's what's happening? And Bernie Sanders, again, who dropped out of the race just recently, that was his whole campaign. The last slide here on GDP is what's going on. This I find really interesting, and you should check this out in greater detail if you have time and desire. But a country called Bhutan, which nobody ever heard of. It's a little teeny tiny country in Asia. And they do things differently. They have a different perspective on what makes up a good economy and what economic success actually means. They don't measure gross domestic product. They measure what's called, and they basically invented it, gross national happiness, GNH. And it has all of these different components here in these different circles. So I won't go through every single one, but look at this: psychological well-being, okay? Ecological diversity and resilience. This is my favorite here, time use. Are we getting enough sleep? Okay, are we working too many hours? So it takes a much more holistic view in each of these points of what constitutes a successful economy. And to me, this makes 1,000% more sense than GDP. I think GDP is one of the stupidest measures of what we should be looking at to figure out whether we're being successful in our life endeavors, not just the economy. The economy is one part of life. It's not everything. So I leave you with that thought. Who would like to contribute their thought of the week at this point? Cynthia, I saw you first. Go right ahead.
So I was just reading an article, and with all of this that's happening, and then reading about GDP, that a lot of people are getting divorced. because, staying at home and they're going bananas. Our levels of divorce were already up, and I'm wondering, like, it just made me think, if more people are gonna get divorced, like the number is gonna go up, how is that gonna affect our GDP? Like, does it have any relation to it? Because divorces are really expensive, and that affects, like, I've seen divorce, and it really affects like a whole family, and then the whole income of the family. So I'm just curious if you happen to have a thought into that.
What do you guys think? It's a great question. Any theories?
Well,
Go ahead.
would it go up? Because, I mean, another person's probably going to leave, and then they're going to, have to buy a whole new set of other things. So another apartment, maybe if they only have one car, so another car, another couch, another bed, everything that goes into, like, the household. So it might change by going up.
That's a really good theory. Let me counter argue it a little bit, because it could happen. If you had an economy that was good, then, obviously what's driving this is the pandemic. But let's say people were divorcing more so because in the context of a good economy, then you have more wherewithal to do that, right? So the counter argument to your argument might just be, yes, normally that would be the case, but because people are losing jobs, and splitting up, that they don't, and when you split up, then it's harder to afford everything. It's much cheaper to live two versus one in a household. So the counter argument could be, no, it would go the opposite direction, because now you have less wherewithal to purchase things.
Actually, that was kind of where I was going with. I thought that it would probably affect us even worse, and I think it's going to be harder for us to come back from it if indeed all this divorce, the number of divorces is going to eventually multiply, then it could affect us even worse. At least that's what I thought.
I missed the point where I was focusing on the point you were saying people are working from home and driving each other crazy. So I missed the point where you said they're losing jobs and stressing out, and then they're, so that also makes sense.
Right, yeah. And I'm sure there's a link between just overall happiness and productivity, because part of GDP is actually not just what we buy, but how productive you are at work. Yeah. So it's so you know what? Seriously, homework assignment. Go out, go Google some studies and see. I'm sure it's been studied. I'm sure. I just don't know the answer because I haven't read the studies, but I'm sure somebody studied it. And so if you can find that for us and tell us next week, that'd be awesome.
Okay, I'll look into it.
Okay, great. Thank you for that great question. Contributor number 2, who's up? Donna.
Unmute it here. I keep going on to the stuff about the COVID because I think everybody is. When we're talking about unemployment, in the book they were talking about how the U.S. Bureau of Labor Statistics tracks unemployment one way. They're saying, okay, if you're out of work but looking for work, and then they said the economists look at it when the market falls into the recession, the demand for labor declines versus, because they said they want to cut the people off from working versus drop the wages and keep more people employed. So the question I have is, we keep hearing in the news that they keep talking about the unemployment, and it seems more that they're talking about the U.S. Bureau of Labor Statistics. But my question is, there's people are losing their jobs. They can't meet that description of out of work but looking for the work because they're not able to go out and look for work, and there's just not the jobs out there. So it almost seems like when the news is talking about unemployment, it's kind of a mix of the two different kinds versus the Labor Bureau and kind of the economics way of looking at it. And so I'd like other people's opinions on that.
My topic, sorry, can I go ahead?
Go ahead, please.
Oh, my topic that I was going to brought up for this week was very similar to that, actually. When I was reading about unemployment and the news that we hear, the unemployment rate is going up, but people are losing their jobs. But then we also hear at the same time, there's a lot of job opportunities at like Amazon or grocery stores or any other, where there's a high demand. So when we count the number of people that are unemployed, and then we're also taking into account that there is job opportunities out there, how do we reconcile the two?
Would that be almost the unemployed versus the underemployed that some people, I mean, people, well, I had this great high paying job before. Why would I want to,
Correct.
step down? So they wouldn't, they wouldn't be, they might be looking, but they're looking
Yeah.
for something in a specific niche.
Yeah.
That's the only place they want to work, or say, I don't want to work there because I don't want to expose myself
Yeah.
to more people. I know it's just the whole thing with the whole unemployment right now is so confusing as to what they're using when they talk about the unemployment rates.
I'm with you, Donna. I think that not everyone's going to be happy to just go ahead and take a grocery store job. And I think that it goes to, yeah, sure, there's other opportunities like at Amazon or something like that. But even if those opportunities, I think that is still limited to the number of people who are unemployed. So I don't think that it would really reflect and balance or, help each other out at all.
Right. Yeah, I look at it. Oh, go ahead. I was just gonna say, we talked about the hours. Like my son was a part-time employee. He's at Home Depot. Laughed because he just walked in the door a few minutes ago, and I mean, he went from being a part-time to being basically full-time plus during this time period because a lot of the people didn't want to continue working there, so they're using up all their leave, and so the people that were there as part-time are now having to pick up all the additional hours.
Yeah. So I have two things to throw in the discussion here. One is exactly what you just said. There's like kind of a shift in where the employment is headed. And I think overall, though, it's still a disaster.
Yeah.
Because the net of it all is just much more jobs are going to be lost than the ones that are going to be gained. Okay. And, even, you've seen the news. Amazon's having problems now because people don't want to work, and same thing at Home Depot, right? Because I want protection, and Amazon's not providing adequate protection, so it's kind of becoming like the hospitals, right? So I think again, net, it's a bad story. Number two comment I'll make is, and this is kind of stealing thunder from next week's discussion of unemployment, but unemployment is a very complex calculation. There are several layers to it, so we're going to take you through all the different layers of how you can look at who's really unemployed, and then we'll think about it in the context of the COVID crisis, about whether there's even a better way to figure it out now that we have this special condition that we just talked about. So there's no short answer to your question, Donna, of how best to look at unemployment, because the ways we already look at it are so different and nuanced, and it depends on who you ask and what exactly you're going for in your analysis. So it's not and just like with GDP is a bad measure too in a lot of ways, as we just discussed. So let's revisit that idea next week, because it's a really good point to bring it up in the context of reality now.
Okay.
But I have an answer in waiting for you next week.
Okay, I'll patiently wait. I'll keep my little notes with me.
Awesome. All right. Number 3, who we got? HR, which would be Jenna.
Jenna. Sorry, I'm using my own work account. I guess I forgot to switch it. But to piggyback on all of this, I know we said try to pick something else, but everything is just so in your face, and like it's all you're really talking about and researching and reading about. When everything, whenever the shelter in place is lifted, whenever all of this is over, we're kind of discussing at work, like things are not just going to pick up right where they left off. Like not everybody's just going to go back to work, and not everybody's just going to go back to what they were spending, or what they were spending or what they were paying, or everybody can't just go back to work if they were just laid off. Like for our employees, like maybe the services we have, they're not just going to pick right back up, like the gym or recreation programs or of any case. I'm wondering, I guess my question is, in the past, I don't even know if this has happened before, or if something like this has happened before. I've never lived through, but in the past, has there been something like this where economies just kind of shut down, and how did they measure like the time it took to kind of get back to normal? Or how do you even measure that?
Great question. Anybody have any thoughts there?
Well, I remember I was here when the recession for 2008, when the market crashed because of all the housing, and what's happening now cannot be compared to that. But to an extent, it gives me an idea that, back then I could feel, I was much younger, but I could feel there was a stop. And not necessarily everybody was in shelter in place, but there were no jobs and people were losing their homes. We lost our home, and everybody was in shock. And it was a really hard 2 years. And though it wasn't this dramatic, I could feel that the tension was very kind of similar in a different aspect. I don't know if I can answer your question as to how are we going to come back, but I know that I'm at company. We are implementing like even a whole different way of going back to work. Not everybody's going to go back to work at the same time, and everybody who comes in has to get tested for your temperature and things like that. So I think from that, I can imagine that companies, like big companies, are going to have a measure of health going on, to still be just precautious about it, and maybe implement a different code of conduct around people, or just to make sure that we still feel safe and trusting that we're going to be okay at work. But I don't know if anybody can answer that, actually. That's my opinion. It's too soon to tell, I think.
So your question was, did we ever have anything that looks similar to this? The answer is yes. The Great Depression. And now it was a different cause. What caused the Great Depression was basically speculation. This was back in the, early 1930s, around that era, right?
Yeah.
Okay. And so what happened there was that there was just so much fraud going on. Companies were taking investors' money, and it was like the Wild West. And then pretty soon the whole thing blew up. So it was actually more similar to what you saw in 2008 with the housing bubble.
Mm-hmm.
Okay. And so, one of the things that came out of that was, if you lived during that era, that you were a cohort that basically was very different from anybody who came after you, right? So if you know somebody who was alive during that time, they're the most frugal people you will ever meet, right? They don't spend on anything they don't have to, and they bargain down price and that kind of thing. So I think you're going to start to see some of that be an after effect of this situation, because I think it's, the issue here is, yeah, you can jumpstart the economy tomorrow if you want. And all those things, Cynthia, you talked about the kind of the staged, reentry, that, you can do that. The question is it really going to work? Because all you need is somebody who's, sick with COVID in a room of 10 people, and then 9 other people get it, kind of a thing.
Yeah.
Okay. So, and they've been saying this all along, which is don't restart everything too soon. But, even if you restart, let's say we restart things in August or September, we give it 6 months, it can still be the same problem. Okay. Because I don't know whether we're going to have a vaccine, whether we're going to have therapies for it, and whether they'll work, or whether the immunity is going to kind of stick with you. So too many unknowns. But what I know is the longer this goes on, where we have to basically cut back because we're out of work or we're underemployed, most of us, you're going to start to see some depression era spending habits change. And you see, you just Google it, you're going to see articles written about it all the time now. And that's what you do to survive. And then it's hard. It's not that they can never go away, but it takes a while to get out of those habits, the more entrenched they are. Because in the back of your mind is always, what happens when this restarts again? Whether it's COVID or some other pandemic, a lot of medical professionals are saying this is a dry run for something even worse. And if you look at the trends, right, you had SARS, you had MERS, you had avian flu. This is not the first pandemic. I mean, this is a pandemic, not the first disease that we've dealt with in the last 20 years. We've been more and more over and I think it has a lot to do with climate change and, encroaching upon animal spaces and that kind of thing. So, by the way, the other thing is, while we're on the topic, the only good thing coming out of this pandemic is the climate is actually getting better. Because people,
Actually, we were discussing that with some of my friends at work. we were talking about how we feel like the air seems cleaner, and that maybe it's a good idea that when everything goes back to normal, hopefully soon, we consider to do at least 2-week shutdown or a week shutdown around the whole country, so that kind of like a re-cleanse every so often. And it could be planned, obviously, and so that, the economy is not affected or anyone's affected. But we thought it was kind of nice that, it does seem like it's much fresher out there than before. I mean,
well, I think,
sorry, good.
One of the things with that, I think, like with the pollution around here from the driving, with the telecommuting, I think it's going to be able to show a lot more employers that people can be productive during telecommuting versus driving. I mean, my husband and I both comment that we work longer hours now telecommuting than we did at home, because we're still up and actively doing stuff more hours, because we're not wasting the hour and a half plus each way commuting to work, and not having people coming by the office. Just the productivity has gone up, I mean, substantially by working remotely. Whereas my employer before, being at the national lab, they're like, no, we don't want you guys working at home. They're finding out that, well, maybe people can. Let's cut down on all that driving.
I've actually studied this issue extensively because I am very interested in it. And I think, as progressive as the state California purports to be, we're not very progressive when it comes to traffic management. We should have been doing this years ago. I mean, just any highway, right? You go on, it's jam-packed. So why does it take a pandemic for us to work at home? And the answer is employers don't trust employees to be productive. Everything you said, Donna. But now they may find out when everybody's doing it, there's still the survival of the fittest. If you're not producing, you're going to go anyway. You're not going to remain employed because everybody else is productive at home. So, I think maybe I'm hopeful that companies will take notice and say, just keep working at home. We'll get rid of a lot of the traffic. The air will get better. People will be more productive, more happy. But then the other problem you mentioned happens too, which is you don't know how to separate work from home.
Right.
So you can burn yourself. So you have to watch that aspect of it because that's important. But
that's actually really hard. I've been working a lot more now than I used to work before, and I miss having to just say, okay, I'm done with my day and going home. And now it's like, I can't do that. I need to answer to emails no matter what.
One of the things I've tried to do, and I was talking to one of the psychologists from the lab, and I may have said this before here, I've told a lot of people, she said, kind of get up in the morning, get dressed, go for a walk. And then, set your timer, and when your day is supposed to end, get up, go for a walk. So that's your commute, if you would say, and it gives you a definitive start and end to your work day. Because we see now, it's like, well, you walk by, oh, wait a minute, I can do something else on the computer for a minute. Oh, go, oh, I can do a little bit more. And we find ourselves 8, 9 o'clock at night still sitting at the computer doing stuff.
Yes, absolutely.
Yeah, because I've been working, I've work from home. I work from home normally most of the time. And so for me, it's busier because I think people are like if somebody emails me and asks for something, like I'll get to it, if it's a priority or whenever it's needed. But for some people, like they expect you to respond right away because they're new to working from home. So they'll email you and they'll call you and say, hey, I just emailed you. I'm like, I saw your email. I'll get back to you whenever you need it. But some people are not used to working from home. Like, so it is a lot busier for me. And also, what was the point I was going to say? Like, there is that you are losing that distraction time or social time where you're going into someone's office and you can just ask them a question. So, they're also expecting that answer right away. So it's definitely a change from me working from home normally and then having my whole office work from home now.
Yeah. By the way, one of the things that kept people from telecommuting more, as I researched the issue, was they just don't want to lose FaceTime. That's the point we're making. And it's perceived, and it was actually true, that the research showed that the more FaceTime you have, meaning literally you're there and they're there at the same place, the more promotion opportunities you get. So the reason why I don't work from home is because I think I'm not going to get promoted if I work from home because I'm not around. Now again, that paradigm could shift. I don't know. I think it depends on how long this pandemic goes on.
I think it also depends on your kind of personality.
Mhm.
I miss being at the office because I'm an extrovert, and it is really hard. I mean, I love my home, I love my dogs and everything, but I miss just like talking to people. And it's really difficult. And it's actually really distracting because I'm thinking about it. Like, oh, I wish I was at home. And I'm not really able to focus fully because now I'm starting to get really anxious. And not a lot of you know this, but I was at home even before the pandemic started because I had the surgeries and I couldn't even move. So I've been at home now for almost like 2.5 months now, pretty much, right? Something like that. And I really want to go back to the office.
I'm an introvert in a house. I'm an extrovert in a house full of introverts. They're all happy to be home, and I'm clawing at the windows to get out.
So I'm ready to get out.
Yeah, the anxiety is going to have to be managed by however you do it. Therapy, I don't know, because a lot of people are feeling anxious. Yeah, we know that. All right, good discussion. What I want to do is just do about 10 more minutes, and then we'll take a break. I'm going to talk about a related concept, which is economic growth. Let me share that screen with you. Okay, so here we go. Economic growth. You see economic growth? Thumbs up. Cool.
Mm-hmm.
All right. So we already kind of defined the way in which you figure out standard of living, which was real GDP per person. If we just look at percentage changes in GDP, we're going to use that as a measure of economic growth. So literally, it's a percentage, and you've already seen similar calculations and other kinds of quantities when we did we did elasticity, new versus old over old, that kind of thing. So it's the same kind of logic here, where you take the real GDP in the current year or the current period. It doesn't have to be a year. You subtract the previous GDP, in this case last year, and then you put it over the last year's real GDP. Notice again, we only use real GDP. You never, ever, ever, under penalty of death, use nominal anything, okay? Because it will give you distorted results. So, quick example, if we had 8.4 trillion of real GDP this year, 8 million flat last year, so 8.4 minus 8 over 8 is a 5% growth in real GDP, okay? And then, of course, there are benchmarks for what is good and bad. We'll get into that in a second. Then we come back to the calculation we did before, which was real GDP per person or per capita. So you just take the real GDP number and put it over the population you have living in your country. And it's literally everybody. We don't distinguish. I don't care if you're a toddler or if you're 99 years old plus, okay? You're a person and you get counted in that population. And the reason why, think about the logic, why do we use real GDP per person as a measure of standard of living is, well, okay, let's break down the components. Real GDP is measuring real production, stuff that people can consume, okay? And then the population is, how big a country are we, right? So you can have a lot of production, but if your population's getting big, then there's less and less for each person in that population to consume. Okay, inequality issues aside, let's not worry about inequality, even though it's a big worry. Just looking at it simply, the real GDP is looking at whether your production is outpacing or keeping up with or even exceeding the growth of the population. Because the basic theory is the bigger your population, the more production you need to feed that population with products, basically, okay? So that's why we look at GDP per capita as a good measure of standard of living. It's not, again, the only measure, as we saw with Bhutan, right? And so then we want to look at trends in GDP per capita, just like we look at trends in real GDP in total. So here's an example. If we look at the current year, real GDP is 8.4 trillion and the population is 202 million. So just divide those two and you get 41,000 per capita GDP in the current year. And then in the prior year, we had less GDP, but also less population. So it all nets out at a little bit lower of a per capita GDP of 40,000. And then we can take those two numbers and do a current minus prior over prior, and we get a 4% growth in real GDP per person, okay? And is that good? That's actually very good. That's a great number. If an economy had that, I would be pretty happy, just like I would be happy with a 5% increase in real GDP. So it would behoove you to know then, how do I grow my country's GDP if we can agree that GDP is a good, higher GDP is a good goal, which I don't always agree with for aforementioned reasons. But let's assume again that it's a good measure. How do we grow GDP? And so it comes down to two overarching themes. One is you grow your factors of production, right? So land, labor, capital, entrepreneurship, just more of that. Okay, most countries, how do you grow land? Well, you know, how do we do it in the Bay Area? We take landfills and we make them into land that people live on, because land is so scarce here, all right? But a lot of times you can't grow your land, so you're stuck. You can't grow your capital because the money's flowing out of the system, right? Just like now, I don't know where the money's going, but it's certainly not coming to the US. So that's point number one. Point number two is you increase your productivity of your factors. And productivity is exactly what it sounds like. It's, can the factors make more? It's not that you have more of the factor, it's can the factor make more based on being more efficient and using technology. Okay, so that's the starting point here. Growth, GDP growth, as long as it doesn't outpace the population, does increase our standard of living, theoretically. But we have to be more productive with each hour of labor, and that's the productivity piece. And so because your resources are often constrained, your factors are constrained, typically the way you increase GDP is through productivity increases. Not the only way, though. So let's look at productivity then. How do we define it and measure it? It's a very simple formula. You look at what your real GDP is for whatever period you're measuring, and then you look at this thing called aggregate hours. That's how many hours people are working. Okay, so what you want, theoretically, is a really, really high number on top and a low number on the bottom. Because, you know, if we're producing a lot but we're working a lot, then the productivity is not good. But if we're producing a lot and we're working not so much, then you've got a high labor productivity coefficient, and that's supposedly what technology is supposed to do for us, although I dispute that. A lot of times, think about social media, right? It used to be that we use computers to save time. Now we're using computers to waste time. Because you're on social media 10 hours a day. Okay, I'm not saying you guys. I know you're not the culprits here, but a lot of people. Okay, so I always dispute that technology is necessarily making us more productive. I don't think it's always the case, but it depends on what we're talking about. Okay, so you understand the formula. Quick example: 800 billion in real GDP for a period, and then 200 billion hours worked gives us $4 of GDP per hour. And that is a measure of labor productivity. Is that good or bad? I don't know, because I don't know what the benchmark is. But obviously, when you calculate these numbers, you have benchmarks against which to compare. So how do we grow labor productivity then? 3 different ways. One is, and these two go together, savings and investment in physical capital like machines. You know, think about the factory floor kind of a thing, build another factory. How do you get money to invest in that? You have savings, whether it's a business savings or individual savings. Individuals then invest in businesses through stocks and bonds. Businesses take the money and invest in physical capital. So that's point one. Point two, you have human capital, which is basically all the things in our head that we know and know how to do. And then you have technology itself, which is not the same thing as physical capital. Make the distinction. Technology is, well, computers are technology. Physical capital is more about the machinery, but technology is, you know, computers and what computers can do, and things that have computational advantages. So one of the concepts you want to get familiar with, because we talk about it all the time in economics, is diminishing returns. In general, diminishing returns means the more you do of something, the less good result you get. Okay, so, you know, think about eating ice cream, something pretty much everybody likes. the first, you get your ice cream cone. The first lick is great. The second lick is good. Third lick is okay. And then pretty soon you get bored with it. So the returns to you as a consumer of this good, even though everybody loves ice cream, it starts to get less and less over time. So that concept pervades throughout a lot of economic analyses. In particular, the one relevant here is returns to capital. Okay, so all this machinery we're buying to make stuff, if we're starting out at a low level of capital and we purchase more capital, then the increase in productivity you see is much, much higher than, and this is what the diagram is saying here. Here you're at a low capital and you're increasing your capital to the right here. So you have the productivity gain is big. You go from 30 to 50, okay, in productivity units, which is real GDP per hour of labor, which we just defined. But if you're over here on the curve, where you've got a lot of capital, don't worry about what these units mean. We're just saying a lot of capital here versus very little capital here. And now you have the same increment and increase in capital. So from 180 to 220, which is still a 40 increment. Well, look what happens to the productivity. It basically flattens out. You're gaining very much less in productivity gains as you add more and more capital. Okay, so that's what we call diminishing returns. And here it's for capital investment. And before I talked to you about it in terms of ice cream, but it's the same idea. So the point number 2 I made was you have human capital. Okay, human capital is everything that we know. And the more human capital we amass, the more productive we're going to be. So human capital relates to how much education we have, how much training we get, how much job experience we get. And then the one that you don't often think about as much is health and diet, because we're much more productive. We have much more human capital when we are healthier, right? Because we call in sick less. We're more focused on the work. We're not worried about going to the doctor all the time. And so what does health revolve around? 2 things: stress and diet, basically. And well, genetics. Genetics you can't influence, but you can influence your diet, and you can influence how much you work out. And most people aren't influencing enough because they're basically owned by their work, and the work dictates how much exercise they can do and what they're going to eat. And so this is all wrong. I've long been, I'll leave you with this, and then we're going to take a break. I love what France used to do. France is no longer France, by the way. If the last time you were in France, you wouldn't recognize it based on its stereotypical image. But, in France, you used to be able to take a 3-hour lunch and enjoy yourself, okay, and digest properly. And so I'm saying, why couldn't we do that here in this country where, employers wouldn't get on our cases if we went out and had a nice lunch and hung out with friends and took time to digest and eat good food. Now we throw a sandwich down our throat, and that's lunch in 5 minutes, and you're back to work. So I think that's totally pathetic, and that's why I'm running for president. Just kidding. So, okay, it's time for a break. I'll see you back in 15. Record. Okay, so I'm going to pick up where we left off. We're talking about ways to increase human capital, and then I want to kind of seg into competing theories of what kind of economic growth you can end up with. It turns out, there's tons of theories around this, and maybe you have your own theory, or you'll think up one pretty soon. But there's kind of 2 opposite ends of the spectrum with this, which is to say that you have the classical growth or Malthusian theory, which is kind of pessimistic. And it says, well, here's what will happen. We'll become more productive, and we'll see increases in real GDP because of things like technology. But the increase in real GDP per capita, which is our main measure of standard of living, remember, is only going to be temporary because now there's going to be more births because we have this prosperity. So prosperity induces larger populations, population explosions maybe even. And so all the benefits you got from increasing your real GDP now kind of get dissipated over a larger population. So then real GDP plummets because your population increases. And so, in the US, we're not really worried about population increase. It's not really been a problem ever for the most part. Countries like China, India, to name two, they have always been worried about population because they're the two most populous nations in the world, right? So what did China do? It limited, for a certain period of time, you could only have one child. Now they changed that rule a little bit, I think. India never, I don't think ever limited, but India's got an population explosion problem. So, you know, this theory, I think, applies to countries like, or could apply to countries like that. It doesn't, in my mind, apply so much to countries like us, the US, because we don't see population explosions, even when things are good. In fact, when things are good, think about the last, 8 to 10 years, population went the opposite direction. It was basically getting a little bit smaller, or at least the growth in population was declining, because with economic success, you had increases in cost of living, okay? So, just look at Bay Area rents, right? You can't afford to live in the Bay Area basically anymore unless you're making a lot of money. So because of these side effects, what we call externalities in economics, I think this theory has some problems. But you have to understand when this came out, this theory came out, we were seeing a lot of shortages of commodities like gas, okay? So this theory was born in the 70s when we didn't know one day to the next whether we could drive our car down the street because gas was in limited supply. And so in the 70s, we were always worried about supply of key resources. And so therefore that gave birth to this kind of mode of thinking, which is our population is going to outpace the resources that we have. So the opposite end of the spectrum then is the new growth theory, which says because we always want to increase our standard of living, we will find ways to become more productive all the time, and the productivity then sustains the economic growth over time. And it's this model in particular talks a lot about the choices we make. Things like how long do we want to get an education for? What do we study? What's a lucrative
Are you
path?
interested in learning about finance?
What?
Oh, okay, sorry. Somebody's having a
Oh, sorry.
No problem. So this theory is a lot more optimistic because it says that we will find ways to be perpetually more productive because we want a higher standard of living, okay? And so the basis of the model is human capital grows because of the choices like staying in school, studying. And, look, you're all in school, but I would tell you school's not the only thing. You don't have to be in school to learn, and you don't have to be in school to increase your productivity, but it's a good way to do that. And then I think bullet point 2 is the most important. Discoveries result from choices. So if everybody's focusing on something, they're learning all they can about it, they're making gains in research and development. So think about the coronavirus vaccine now. Everybody's focused on it, all the pharmaceutical companies, okay, because obviously it's what we need. So we're gonna get, most likely, a result on that. I don't know if it's gonna be tomorrow or 6 months from now or 2 years from now, hopefully tomorrow, but probably not. But the point is somebody's gonna figure it out because everybody's focused on it now. And so that's the way societies are. The ones that, the most successful from a GDP growth perspective is they figure out the things that really matter, and they focus their attention and energy and resources and R&D on building those solutions, okay? So that's the second bullet point there. How many people are looking for a new technology and how intensively are they looking for it? But then when you have discoveries, I'm not gonna say the coronavirus vaccine, but other kinds of things, everybody is a copycat, right? So business sees something being successful, they copycat the idea and they get their own hand in the market. And so the boom that creates kind of gets dissipated over time when you have competition engaging in friction with each other, competing to sell the product. Consumers do better, of course, from that. But this diagram, I think, nicely shows the circular flow of how new growth theory works. It starts with always wanting a higher standard of living. because you want more things. I'm not saying it's always a good thing, a good way to think, but you want the bigger house, you want the better car, you want the better school for your kids. So some of our wants are good, others of our wants maybe are excessive, but that's a debate we could have at another time. The sum total is higher standard of living desires. We have incentives that help us reach various forms of innovation to fulfill our need for a higher standard of living. And that leads to better products. If we have better products, if you follow this line, it means we consume more because there's better stuff out there to consume. And then there's better ways to make products. So the fact that we have better processes and better products means that new firms come into existence. The old firms that don't change go out. But now we get better jobs that are newer and better because we have better processes and we're more productive. And that all leads into higher standard of living. And then hopefully, and this is the one that I think doesn't come true as much, is more leisure time. Every study I've ever seen, I've seen leisure time decreasing over the years. We're making more money, higher standard of living, lower leisure time. So that one is harder that nut is harder to crack, so to speak. Okay. So which one do you believe in? I don't know. You can think about it and get back to me, but which one I think is a little more relevant to what we're seeing here in the US, it's the new growth theory. I think this one checks out better than the Malthusian, which basically says real GDP is ultimately going to go down. We haven't seen that over the long term here in the United States. In most developed economies, it's pretty much the same result. So whoever invented new growth theory, I forget the economist's name, I think had the better model for most of the developed world. Okay, so the last section here is how do you get economic growth? What are the preconditions, and then what are some of the requirements or the things that kind of help it along? So a precondition, which means you can't even think about having economic growth, which is growth in GDP, unless you have this in place. It is necessary, but not sufficient to have economic freedom. Okay, and what does economic freedom mean? Basically two things. Your private property is protected, so nobody can come to your house and take your stuff. Nobody can come to your business and take your business property. And then I can trade in free markets, right? Whether I'm selling and buying stock or whether I'm selling and buying goods, services, I have the ability to do that, which by the way is not always a guarantee here in the US, because think about, what's going on now in the stock market. There could be some cases where you can't sell your stock because, you want to sell it yay high and the market dropped in a heartbeat down to here, and you're not going to take that loss. So really you're seeing actually a decrease in liquidity and the ability to trade. It's not that you absolutely can't trade. It's just that the result of your trading is going to put you in a really bad position. You're going to lose a lot of money, right? So essentially, there's a restriction on trade now. And this is what you see in a lot of down economies. So even in a country where we value free markets and have free markets for the most part, don't think that they're always free, that you can always get what you want and need. The property rights issue, go to certain countries in the African continent or in Latin America. The government can come, China even, the government can come and take your property at any moment, right? So you invested your hard-earned money in a building, in a business, some land, whatever it is, and the government decides, well, one day, oh, we're going to take that over because we need it for our own needs, or they don't like you because you're a foreigner in their country. It's called appropriation. Happens all the time. Okay, now, can it happen here in the U.S.? Yes, but it's, if the government's going to take your property, they have to compensate you fairly. And there's a whole branch of law that deals with that. But the point is, in America, pretty much you have property rights. Nobody's going to take your property unless it's an extreme circumstance. And usually you're compensated for that fairly. Other economies, other countries, not necessarily the case, especially when you have a lot of political instability. So the government might have been favorable, and now they get replaced by a coup with a new government. And look at Venezuela had that problem several months ago. So free markets matter, property rights matter, and they're not a given anywhere in the world. And they're not even a given necessarily here in the United States all the time. Okay, so the precondition is met, hopefully, and then how do you accelerate economic growth, GDP growth? Three major overarching themes: growth rate of capital per hour of labor, right? So that's, again, just look at the factors. Growth rate of human capital, and then technology, of course, is going to matter. And then how does the government help this along? So we have, 5 bullet points here. We're going to deal with each one in turn. But the overall theme here is that governments can nudge. They can't do the work of actually innovating and driving productivity growth. They can set up the circumstances under which these things will happen. So the old saying, you can lead the horse to the water, but you can't make the horse drink. The government's leading the horse to the water, but the economy, the companies that operate, the people who do the work have to actually drink the water, so to speak. So first is creating incentive mechanisms to basically save money. Because when you have savings, you have investment, right? What are you doing? When you're saving, you're putting the money in the bank. The bank is loaning the money out. Or you're buying stocks and bonds, which is a loan to companies. And now they have money to invest in R&D, to invest in technology, to invest in advancing their business, basically. So you have to, it starts with savings. You have to create incentives to save. So things like, IRAs are really for your retirement, but they're also still a form of savings. And so they in the long run, they might help economies, they might not. I've never actually seen a study on it. The problem with IRAs is it takes so long to be able to use the money, and you're not using it for anything in the interim. But then you have the money later, which you can invest if you don't need to use it all. But things like that, where the government's trying to get you to kind of put money away, treasury securities, that kind of a thing, can help create incentive mechanisms for investment. Encouraging research and development, giving you tax credits for research and development. What is research and development? Spending on experimentation, basically. Experimentation in new products, new processes, new technologies. So any company that's going to want to succeed long-term is doing a healthy amount of R&D, but you have to have money to do that. And so the problem is, the government for the longest time doesn't really get involved in making sure that companies are doing enough research and development. The government other than the military for the most part, the government's not doing much in the way of research and development. So it has to create these incentives for companies because government itself won't get involved in coming up with technological innovations that the business world can use. International trade. The argument is mostly that the more international trade you have between countries, the more economic growth each of those countries is going to have because you are extracting gains from specialization. Okay, we'll come back to this point in greater depth later. But the point is you do what you're good at, we'll do what we're good at, and you're going to have much bigger productivity gains focusing on what you're good at than trying to do everything, which means when you try to do everything, you don't trade at all. Okay. Now, and we'll get into this later, the quick counter argument to international trade is, you become too heavily dependent on other countries for things that you need. And your productivity can suffer because of that too. You can't, you outsource something for the longest time, you didn't produce it domestically, now you need it, and the suppliers aren't supplying, so there goes your productivity. So I don't think it's not a perfect argument all the time, but it makes sense in a lot of other ways. Improving the quality of education, basically the states do this. The federal government tries, they have standards. Common Core, you might have heard of that, is a movement across the country to standardize curriculum, make it more rigorous. The jury's out on whether that's going to even happen all over the place and whether it's going to be successful. But the intentions are good, which are to get education to be a higher quality product for school children. And then you have also a push towards STEM education, science, technology, education, mathematics, where schools are getting funded or getting kind of special favors from the government if they pursue STEM kinds of programs, because we tend to think that that's the most important thing to learn when it comes to developing technology. It would make sense, right? So as I said before, all of this that the government can do is nudges. You're not going to dial up a big increase in productivity by these measures and processes and programs alone, but it's the kind of thing where the sum total is greater than the parts. that make up the total, because you nudge here, you nudge there, pretty soon it adds up to a lot of productivity growth over time when companies take advantage of it. And then the differences are large versus if you had done nothing or had done kind of a disconnected effort to increase productivity through all these measures that we talked about. So governments do matter. They can help things, and they can also destroy things. And that's, the debate going on now is how much do we destroy the economy to make sure people's health is preserved? It's a really hard question to solve, and nobody has the right answer. And then it's split along party lines. Democrats want to wait. Republicans want to restart the economy now. So we'll see what happens. I think it's going to be different in every place, depending on where you are. Okay, let's hear from 3 more of you. Who's got some contributions? Go ahead, Laura.
Mine was kind of picking back up on unemployment. The book spoke about companies that instead of lowering wages, they would lay off individuals who, and in our company, it's more like a comment, because in our company, they kind of did the same thing before they did company shutdown. We were kind of seeing that in the Bay Area they had started, and we kind of thought they were going to move more this way into the Central Valley, which they did. So we were preparing in advance, and we were already trying to lay off people we thought, or making a list of individuals who we thought were not essential to the business and who wouldn't make such a big impact to the business if they weren't around. And instead of lowering wages, they turned to laying off people, because I guess they wanted to create this morale that the people that stayed were very important to the company. They did consider the fact that if the company did have to shut down completely, they would still pay the employees up to 2 weeks without going into unemployment or going into other benefits. But as far as I'm seeing it from my perspective, who's still working there, I feel like these employees that did stay are being tremendously overworked because they're understaffed. And I'm just thinking about how much impact it's impacting me as a manager and my accountants, who minimized from a 6-person team to 3, and how much they're being overworked and how much overtime they have to be putting in, because we don't have the capacity we used to 3 months ago. So I don't know, that was just a comment I wanted to throw out there.
It's a common occurrence. You see that pattern all over the place, where you get rid of some of your workforce, and then, but as you said, the wages stayed constant, right? Yeah, for those who remain, because you don't want to lower morale of those who are still there, and then the ones who remain are overworked.
Mm-hmm.
Yeah, so if anything, their wages should go up.
Yeah.
The company can't quite afford it, probably, yeah, or they don't want to afford it. Anybody had a thought on that?
I think it kind of goes along with the ones how we were talking about it earlier, that, you know, in the book, they were talking about how the last thing you want to do is lower the wages. So it's almost easier for the companies to lay off people, but that's what we're seeing. They're, you know, getting rid of people, and then those that are left behind are getting the lion's share of all the work to compete, because the company wants to be ready whenever they can go back to restarting activities. And that's just be a way of life for a while for a lot of people, unfortunately.
Okay, other thoughts there? It's tragic, you know, that's all I can say, basically. I don't have a good solution.
I wonder how resilient how much we can pull the American economy, how much it can withstand in terms of the dramatic unemployment. It's unprecedented. The number, you know, if you look at a chart, it's like, and then it shoots off. It's extremely flagrant when you look at data. So I guess that's always my thought. It's like, imagine we had to be like this until next year, January. You know, how much pressure can the economy take as we navigate COVID? Because it's really COVID that's driving this whole process, you know, of being home, of changing how we work and live and shop and consume, you know, and interact with each other.
One question I have along that, Jordan, you may be able to provide some insight. You know, they, like Serena's saying, very unprecedented levels of unemployment. But how much do you think once the economy gets going we're going to see, you know, it's not going to come down as fast, but you're going to see a pretty steep decline? I was talking to a friend of mine who works at the MGM Hotel in Las Vegas. Well, since the hotels are shut down, they laid everybody off. But they said, you know, but as soon as we can open back up, we'll be rehiring, you know, most of the staff. And so, I mean, yes, I'm very concerned about the steep increase in unemployment, but I think we're going to see a pretty steep decrease also in the employment. Like I say, not at the same rate, but when businesses do go back, because it was just easier for them at the time to say, we have to shut our doors, we're just going to lay everybody off instead of maintaining them at some level of employment at that time.
Right. So two points I want to delve into. One was, I'll just deal with the one you brought up, which is, yeah, you'll see a rebound, but I think what tends to happen after any recession, or especially a depression, is it's cautious optimism, right? Mm-hmm. So we're not going to take back everybody. We're going to be slow about it. We want to see if the COVID's going to rebound. But also in the interim, so the businesses that wound up staying open, they found better ways to operate more efficiently with less people. Efficient. So, okay, we don't need people as like we used to, okay? And then the whole effect of what's gonna be virtual now that was at one time it was brick and mortar, okay? So maybe we can lower our overhead through employment that way too. So you're gonna see some of that. Coming back to Serena's really important question, how much can the economy take before things just go, you know, haywire? The question I ask is, well, okay, you know, obviously the first question is how long is this going to last, and then how many people get unemployed? Let's say it's like 30-40% unemployment, which I don't know. I think that seems extreme. 20% is not out of the question, but I'm not the expert on it. I'm just guessing. But my bigger point is, what happens when you have severe unemployment? What do the government do? They pay unemployment more so than they have before. Okay, so the question then is, how do governments, whether it's state or federal, because it's really a combination of both, how do they afford to do that? Money doesn't come out of thin air, right? So that comes down to a couple of things. How do you create money in a situation like this? One is you borrow. The problem with borrowing is, who the hell else has money in this? It's a global pandemic. Everybody's suffering, okay? So, but there's probably some countries out there that have some money, could lend it. I don't know who they are, but I don't think it's China at this point, and that's who we borrowed from in the past. So that's going to be a big factor is, you know, if there are parts of the world that the economy is good and they're willing to lend to us, then you'll stabilize the unemployment, not necessarily the unemployment itself, but the effects of it by these payments, which is just basically more unemployment than you would ordinarily get. Number two thing you can do, which is very dangerous, and we're going to talk about this next week, is you can print more money. And we all know why that's a bad idea. That drives inflation. Okay, but it's still an option. It's just that you're paying Peter for Paul, that kind of a thing. Whatever that expression is that I didn't get straight. But it's too many artificial props, and that eventually is going to come crashing down if you do too much of that. But it's still an option. So, you know, and there's other things I could keep going on, but my general answer to Serena's question is the economy I'm not worried about the economy, I'm worried about people and whether they literally run out of money because the government runs out of money. And that's when you have pandemonium, is when you can't pay unemployment. So people, how do you pay your rent? How do you live anywhere if there's no money coming in from any source? What should happen, again, if this persists, is rents should come down, mortgages should go down. You should be able to renegotiate a lot of contracts because otherwise everything's going to go empty, right? Think about the landlord that owns the building in San Francisco or wherever, and half the people are unemployed. So what are they going to do? Kick half the people out and replace them with who? who else is working? So I think you're going to see a lot of that again if this persists. If we go back to normal in say July or August, and then things stick okay, then it's just going to be a quick hop, skip, and a jump, and we're going to we'll stabilize. I don't see that happening. I think this thing is bigger than a 3 or 4 month hiatus. I don't know that it's a year, but I don't think it's a 3-4 month project. So I think you're going to see a lot of renegotiations because it's going to persist. I hope I'm wrong. Anybody have a thought?
I do actually. I was reading on how unemployment is viewed and dealt with in other countries. And in comparison to the US, some countries, what they do is if you show up to the unemployment office, I don't have the money. So instead of just giving you money or saying I went and did these interviews, they go ahead and give you kind of like task for the community. So whether it'll be like cleaning up or helping the elderly or whatever it is. And they have a system where you check in like essentially like in any job, check in and check out. And based on the hours that you put into the day, then they give you an amount. And the amount not necessarily is money, but they give you shelter and they provide you the food on their terms. And in some other cases that is much more in depth, they go even about preparing you to get you an employment that could sustain you on your own. And it's like a program. And I think that what you brought up that this is a global thing. It's not just like happening in the US, but all over. And so I think that my prediction is that if this continues the way it is, we're going to have to revisit how we deal with unemployment, because we can't just give all our fund days out for everybody who doesn't have money. So I think that maybe the government should reconsider how can we better assist and not just giving them money for people who are unemployed. I think that would be a great option now, because the way it worked in Spain, it was like that. And it seemed that people seemed much more driven to get out of unemployment because they actually had something to do. So also mentally it was healthy for them too.
Interesting. So pay, well, not necessarily pay, but provide resources for community service.
Yeah.
Interesting. Now, again, a lot of this is politically driven. Democrats probably like that idea. Socialists like that idea. Republicans, no way. So a lot of what's going to wind up happening is depend on who's in office.
Yeah.
And we have an election coming up, but that's a long way off, basically, relative to our time frame. So, yeah, really good question. Let's keep moving on. Excellent question, though. Hard to answer with certainty. Who's up?
Well, I guess I'll take this opportunity to talk about Keynesian economic theory and neoclassicism, because this is what it leads to, is the government's role in how you manage the ability of a government to leverage vast amounts of money to either have social programs in place that are major. Social Security is an extreme, but we are in extreme times, as opposed to the neoclassicists who believe that, as we go back to work and start having our, businesses produce and hire people and so on, that the economy will regulate itself, and that the government it's not their role to manipulate that, and people will eventually go back into the employment market or be employed again fully.
Right.
As I understand it.
Right. And that's what you see playing out to a certain extent with the Trump versus the governors. Trump is more on the neoclassical, and governors are more Keynesian, as you're pointing out, which is the government should get, again, extreme circumstances. Why is it so bad that the government gets involved all over the place? They should. That's what they're there for. They're there to provide that cushion. It's just that you have opposing political philosophies, and that does affect, practically speaking, what actually winds up happening. Just look at, again, who's willing to reopen versus who isn't. So yeah, I think it comes back to the same endpoint, which is depends on who's in office and how they gang up with each other to get these programs passed or not. And it's some would make the argument, things are so extreme, you would think Republicans would change their mind and be more like the Democrats, and it's not bearing out that way for the most part. They're just doing the same old routine that they were doing before. So anyway, that's politics, and I'll stop talking about that. But yeah, no, it's a great question. Where are we going to end up? I don't know. Okay, cool. One more.
To connect to the Wi-Fi network, you might want to check the connection settings in the.
Who else we got? Ready to?
Okay. Hello. I was reading an article that kind of connects everything that we're speaking today. It was referring to the real estate market and how the business is going down because people are pulling their houses from the market. But sometimes that's not all the problem because people are pulling the houses from the market. There are no new houses to build because all the materials of maybe the 30% or 40% of the materials comes from China. So the home builders are without work because they cannot continue build new houses, and because there is no build new houses, the market is going down and going down more because there is no offer. And sometimes people, since the 2016, when the market started going up, now it's going down again. So people doesn't know how it will recover in the next 6 months or in the next year with this pandemic.
Okay, so in a nutshell, in the real estate market, builders can't find supplies because China can't supply them.
Exactly. So there is no offers, there is no new homes, no new projects. People cannot buy new houses, and the houses that already exist are out of the market because people don't want to sell in this time.
Right. So you have a double whammy. People don't want to sell because they lose, and then you can't build any more. So the inventory is really low, and there's nobody basically selling houses. Right.
Correct. And in the last few years, the market was growth. It was recovering from the recession that we have in the mortgage. So it is happening again. So I don't know how much it can take how much the economy can take in the real estate market because it will happen again in less than 8 years. It will happen again. So I think that there is a pattern going with the real estate market.
Say that again. The last thing you said.
I think that every time that we recover in the market, something happens again. I don't know how much it can take.
Yeah. So it's kind of the same point that Serena was making.
Yeah.
At what point does it all cave in? Well, who knows? Anybody have a thought? What's going to happen to real estate?
Well, now the question I have is if they're not being able to build, there's not the houses on the market for the people that do want to buy. Is there going to be now a shortage of the homes, and will it drive the prices up on the ones that are available? Because so many people are pulling them off the market. It'll be interesting to see what happens with them here.
Yeah, it's a supply and demand situation, and I think I've done a little searching myself over this past few weeks. I'm trying to buy up in Oregon, but you can't buy anything. First of all, nobody will even show you a house because of they're so afraid of getting COVID when you walk in their house, right?
Right.
So there's nothing on the market. So yeah, what is out there? I saw two results. One is very little to buy, and then the ones that were available, the prices were actually dropping because they're worried. The sellers are worried. If I don't sell now, I'm not going to sell in the next year. If this thing persists.
Yeah.
But that's not every market, so I don't know. I think it depends on where you are.
Yeah. I'm at home here. In like a distance in one day, I think the price value of our home just went up by the highest is up by 20,000, like in super fast almost overnight. But across the street, they're also selling a home, and next door, they're also selling a home, and it just made me think there's literally two other houses next to us, and they seem that their prices went going down, but ours kept going up. So I thought that was really interesting because it's literally right across the street from my home.
That's very strange. Most cases that should never happen.
Yeah.
They should all go up or down together for the most part. Wow.
So
Here's
I don't,
one. Sorry.
I don't know what's with that. I don't know why made that happen, but I just thought that was really interesting.
Yeah, well, there's something about your place that is differentiated from the others. We don't know what it is, but it's something. Here's the thing I worry about. You know, a lot of us have equity tied up in our homes in the Bay Area, and we expect one day we'll retire and cash in that equity, right? What I'm worried about, and it's probably an overblown worry, but if this pandemic persists or we have a series of them, people stay at home all the time, what's going to start to happen is that the big the popular places to live, like the Bay Area, it's going to be irrelevant. You could live in the middle of Nebraska, and your house could be worth more than a Bay Area house, because it doesn't matter where you are if everybody's working virtually. One of the big reasons why the Bay Area houses have a lot of value is because there's job opportunities. But if jobs are all virtual, what does it matter, right? And if you can't go out to the restaurants, what does it matter where you live? So I'm a little bit worried about that, but not a ton worried about it, because it'll probably come back. So we'll see. Okay, really good. Okay, I'm going to go back to, no, I'm not going to go back. We're going to look at statistics now. So let me do a screen switch here. So as I said before, we are now in a position to do all these statistical tests that we've been setting the stage for. So we're going to start. We all see the chapter 10? Yes? Cool. All right. So this is the first of very many tests we're going to look at, and it's called the one sample Z test. And really what you're doing here in a nutshell is just trying to prove that a mean that you calculated is the same or different from some other number. Okay, so let's say it's the mean of incomes in a group of people, okay, and it's 50,000. Well, you took a sample, and the sample came out at about 50,100, and the question is that 50,100 the same as 50,000 statistically? Because remember, again, we never think that two numbers are the same or different until statistics tells us that they're the same or different. So that's essentially what the one sample Z test is. Here, the language is a little kind of fancier. It says we're examining differences between a sample and population, but the population number is a guess, it's a hypothesis, and we're looking to see whether the sample confirms or denies that hypothetical. Okay, and we're only looking at one set of numbers. Very simple, simplest test ever in terms of the data that goes into it. So if you like using these charts, I'm not a big fan of this because it's in my head. I've been doing stats for years, so I don't have to rely on a flow chart, which is what this basically is. But if this works for you, use it. Here we're centering on the difference, examining differences between a sample and a population. And the crux of it all lies in this formula. We're gonna, and I'm sorry this didn't print so nicely, but basically you're calculating a Z statistic, which is basically the same as a Z-score. Remember we did Z-scores last time, and the Z-score told us how far from the mean we were in standardized terms. Well, that's essentially what you're doing here, is you're saying, okay, Z is a mean minus a hypothesis.
Hey, Martin?
Sorry? Good? Okay. It's the mean that you find in your sample subtracted from the hypothesized mean, which again is whatever number you think it should be. Okay, that you have some evidence that it should be this number, and we're looking at the difference between the two and then standardizing it with a standard deviation term. And as you're going to find out, this standard deviation, sigma over square root of n, doesn't actually work. What you have to do instead is take little s and put it over the square root of n. Little s is the standard deviation of the sample that you have. You have the sample data, you don't have the population data. How the heck did you figure out this sigma here is a population standard deviation? So we replace it with the little s, and then we're on our merry way. This whole standard deviation term winds up being called the standard error of the mean. None of this really matters because Excel is going to do this for you in the background. So who really cares? But just understand kind of what the inputs are to the formula. And this is your again, your test statistic is this, using the SEM as a substitute. Now, the other thing I also say is, there's a process behind hypothesis testing. It's all going on simultaneously. When you pull up Excel, Excel is basically going through all these steps at once. But the thing that matters the most is step number 3, knowing which test statistic or test to use given what you want to find and given the data that you have. So if you can focus 99% of your energies on just figuring out which test makes the most sense given the data and given the study goal, then Excel will take care of all the rest of this stuff. You don't have to worry about computing test statistic and finding the critical value and then figuring out whether to reject the null. It's all done in a microsecond once you have Excel. So speaking of Excel, let's do the problem of trying to figure out the result to a z-test. And what you might wind up using some of the time, if it's your personal preference, is a dialog box. I'm not big on dialog boxes. You really have 2 choices. You use a dialog box like this to put your data in over here, or you just use the parentheses to put your data in like you've seen throughout the rest of the course. So let's frame this in terms of an actual problem. I'm going to bring up the Excel in a second, but basically let's talk about pretzels. I love pretzels. Okay, and one of the things that matters in terms of how well pretzels taste is the saltiness component. So, let's say you have a focus group or a survey and you give people pretzels and you want to figure out, are these things too salty, not salty enough, or are they perfectly salted, right? So you give them a scale of saltiness, 1 to 5, where 5 is too salty, 4 is just the right amount of saltiness. Depends on how you set up your scale, but there's some significance to the participants marking the saltiness at a 4.0. Maybe that's your optimal point. So you want to know, literally, are participants on average marking the saltiness at a 4.0 level on a 5-point scale? Okay. So if you look at this data set on the left, it looks dead on accurate at 4. Pretty much every number here is a 4, and then there's a little deviation here with a 4.1. On this one, where I'm saying the mean is different from 4, it's all over the place. Okay, so we would expect that when we do this z-test, the z-test is going to confirm that the mean is 4 here, but that the mean is different from 4 here. So let's actually go ahead and do that. I'm going to pull up Excel. Okay, so we all see Excel? Okay, good. So I have the same data here copied, and the way you do a z-test is you literally just tell Excel equals, and I'm doing a z-test for 2 different cases here. And I put it right under, as I've always done throughout the course, I put it right under the data that I'm analyzing. So you use the z-test function. It's z.test. You notice when I got to this point, let me do it again, it brought up 2 options. You have the z.test and the z-test. They're basically the same thing. The z-test without the dot is like the older way Excel used to do it. Then Excel got a little fancier and they put in these dots because you saw it did, with the population mean and the sample mean. So you could literally use either one. Your version of Excel may only have one choice, but the proper one to use is the z.test because it's the more modern one. And then open parenthesis, and then it asks you for an array, an X, and then optionally, because it's in brackets, a sigma. You don't need to worry about the sigma. What you need to worry about is just the array, which is your data. Highlight your data. And then the X, which you have to separate with a comma, is the hypothesized value you're trying to prove the data is approximating. So our hypothesized value is 4. I don't have to put in 0.0. 4 is good enough. It's the same number. And I close parenthesis, and then I hit the check mark, and you get that result here. And I'm going to just kind of give that a little haircut. Oops. We want easy numbers to read. And then I'm going to do the same thing over here. I'm going to tell it to do a z-test for this data, z.test, open parentheses, drag across the array of data, and once again specify the hypothesized population mean value of 4. Don't worry about the sigma, it's not relevant. You don't need it. And then we get this result here. Okay, so I'm actually going to leave this a little bit elongated here because I want to point out that it's not quite 1. It's 9.999 and change. Then you have a 0.03 here. And so this one is a little confusing, and it's almost a bad idea to start talking about hypothesis tests with this test in first place. But usually when you have a low number here, what's being calculated here is a p-value, level of significance that we talked about last week. And what we said was important was 0.5. 0.5 is the line of demarcation. The way it works for the z-test is if you have a number below 0.5, like 0.3, then that means that your mean is the same as your hypothesized population value, in this case 4. So we can be very, very confident that the average of this data is the same as 4. If you have a number result that is above 0.5, and this one is way above 0.5, it's almost 1, which you almost never get, then you can be confident that your data mean is different than the hypothesized value, again, 4. So yeah, obviously we knew that was the result, but now the statistics is confirming it. The whole point of using a z-test, again, is you have a value in mind. You want to prove or provide substantiation for the mean in the sample being equal to or unequal to that value, and that's what you use the z-test for. The God's honest truth here is this test doesn't get used much. It's a very seldom used test because more often what we're trying to figure out is are two groups different in value and which one is higher, which one is lower statistically. So it's out there, it can be used, it's not used all that often, but for the sake of completeness, we wanted to show it to you. So to go back to the slides, we have one more here on the z-test. So I will get back there and just kind of summarize what we saw. In the first case where we said the mean is probably going to equal 4, we got a 0.3 result, which is less than 95. So you can look at 0.5, you can look at 95. In this test, it's actually 95 that you're comparing against. But the point is that 0.3 is way less than 95. And so that means we have evidence to support the fact that the mean saltiness perception is equal to 4.0 on a 1 to 5 scale. Okay? So remember, again, we gave a survey. We asked you to fill out the saltiness level, and 4 was one of the points on the 5-point scale. In the other case, where the means were looking not equal to 4.0, we got a p result of 0.99, which is bigger than 0.95, which means that we have evidence to support the notion that mean saltiness perception is different from 4.0. Okay, and that's really all that the z-test does, is compare against a hypothesized value. So now we are going to move into the next test, chapter 11. And again, if the chart works for you, use it. Basically what we're saying here at the end of the day is I just skip right down to here. 2 groups we're comparing, because in the 2 sets of data that we're comparing, in the last test that we did, the z-test, you only had 1 group of data. It was just your sample. Okay, even though we looked at it across 2 different cases, it was still 1 group of data at a time. So if you have 2 groups of data and you're trying to figure out if the means are different or the same statistically, then you might wind up using this thing called the t-test for independent samples. And I say the word might because you have to figure out whether you have independent samples. So what do I mean by independent samples? What I mean by independent samples is you have 2 groups of data and they are different people in each of the groups. Okay? So quick example of that would be I have a group of girls, I have a group of boys, and I'm measuring them on some educational metric or something like that. Males, females, You can't be both at the same time, basically. You have to either be in the male group or the female group. Those are independent samples. And that's what we mean. So you got to look at your data and see whether you have that or not to figure out whether this t-test for independent samples is appropriate. So if you think it's appropriate, then the next thing that you do is you look at a measure called homogeneity of variance. You all remember what variance is. We looked at it in the first or second week of class, and we talked about it as a measure of dispersion. We also talked about standard deviation. They're the same thing, just one is the square root of the other, right? So what happens is when you are doing a t-test for independent samples, you can have two situations. One situation is you have homogeneity of variance, which means the variance of the two samples is roughly the same. It doesn't have to be exactly the same, but it's pretty darn close. The alternate scenario is when variance of one sample is high, the variance of the other sample is low, or vice versa, or the fact is they're just not the same variances. So you have what's called a heterogeneity of variance. Either is fine. It is always more preferable to have homogeneity of variance for reasons that I won't get into, but basically you find the result that you're looking for much more often when you do, but you got to know what you're dealing with before you can figure out which test to use. And most software packages, this is my last bullet point here, like SPSS, will actually test for homogeneity of variance and will tell you which t-test you need to use, and it'll show you the results for that t-test, or it will show results for the homogeneity of variance case and the heterogeneity of variance case, and then you have to know enough to know which one to use based on the results of the homogeneity of variance test. So this is a mouthful, and the good news is 9 times out of 10 it doesn't even matter which test you use, because it's basically the same thing. Okay, whether you have homogeneity of variance or not, the results are not going to be all that much different. But we'll come back to that idea in just a second. The test statistic, again, what Excel is going to do for you, it uses this formula, which looks like, again, another mouthful, but I just want you to understand what's going on here so you conceptually can grasp what's being calculated, not that you have to calculate it. You're comparing two means, a mean from group 1, a mean from group 2, the boys versus the girls on whatever quantity you want to study. In the denominator, the main action is in the S1 and S2 squared terms, which are variances for your sample 1 and your sample 2. It's basically creating an average variance by which to standardize this difference, okay? And then the N1s and the N2s are basically sample sizes for group 1 and group 2. So you let Excel do the dirty work there, and you're essentially following this process to compute the t-statistic for independent samples. But again, the main work is in figuring out this is the test I need to use and tell Excel to use that test. And then one little other tidbit I want you to understand is this idea of degrees of freedom. You're going to see this throughout the rest of the course. You might as well understand what it means. Sample size, when you're dealing with one group, let's say we were doing a z-test that we just talked about, the sample size is literally how many pieces of data you have. It's pretty simple, okay? So if we had 10 people that we surveyed for that saltiness study, then your N is 10. When you start dealing with 2 or more groups in a study, then sample size gets a little muddy because do you add them together? Do you take an average of the 2 group sample sizes? What starts to happen then is the statisticians use this concept of degrees of freedom, which is a more complex way of looking at sample size when you're dealing with more than one group. So in this particular test, the independent t-test, for me, independent means, if you look at the formula here, the degrees of freedom are literally the sample size in your first group added to the sample size in your second group minus 2. Okay, the minus 2 is done. I could give you a PhD lecture on why there's a -2 in there, but it relates back to some of the logic we use when we talked about why do we subtract 1 from standard deviation to figure out a sample standard deviation. Don't worry about it. The main action is the fact that we're adding the 2 sample sizes together. And that's the new sample size for this study, okay? All right, but just understand degrees of freedom as a proxy for sample size, when sample size isn't so simple to figure out when you're dealing with multiple groups. Now I want to show you the 2 cases of, I always show you 2 cases of everything, both on the slide and then in Excel. And this should be second nature. You're going to do tons of these, not just with this test, but all the rest of the tests, and it's always the same. Because again, the one outlier was the z-test operates differently. So forget everything you know about the z-test and take in this logic. The way you interpret results when you see them in a statistical report, which by the way, Excel is not going to give you, but you might read about it in a journal article or some other report. You're going to see T of 58 equals some number and then a p-value. Okay, so let's go through each of the pieces. T means we're using a t-test. You would infer that it's an independent t-test, but sometimes that can be hard to know. 58 in the parentheses is the degrees of freedom. That's the N1 plus N2 minus 2, okay? The negative 0.14, the number is not always going to be negative, but that's the number that you get when you calculate using this formula, is you get that negative 0.14. And then the most important number being reported is right here. It's that p-value. In this case, it's 0.27. And we use this rule down here, which is if the number is greater than 0.5, 0.5 is the line of demarcation, that means you have no significant differences, or put another way, statistically similar results. So in this result, because p is greater than 0.5, there is no difference in means. They are statistically similar, whatever the means happen to be. We don't even have the means here, it doesn't matter. Okay, now contrast that with the opposite case, where I won't go through all the same things, but now the p is 0.2, right? So go by the rule again, compare it against 0.5. The 0.2 is less than 0.5, so we now have significantly different means. Or we have statistical significance, it's the same thing. So 2 means are unequal because that p is less than 0.5. What happens if p is 0.5 exactly? Well, you almost never get that, but that's when it becomes a judgment call. Some statisticians will say that's significant, others will say, no, sorry. Most of the time, you don't have to worry about it because you get a number that's slightly different than 0.5 anyway, even if it's close to 0.5. Okay, so let's basically go to the Excel. There are different cases that I want to show you, but the function that you use for the t-test is, so unsurprisingly, t.test, okay? So before you did a z-test, you used z.test. Now you're doing a t-test, so you're using a t.test. And then within the parameters, you're going to specify that this is an independent samples t-test. Again, to review the concept, different people being used in the different samples, or just different objects being sampled. Okay. Now, Excel, I've said this from the beginning of the course, Excel is by far not a perfect tool to do analysis for statistics. It's actually a mediocre tool in a lot of cases. And one of the ways in which it's mediocre is it doesn't give you the test statistic value. So it doesn't give you, just to go back a slide, it doesn't give you this number, but it will give you this one. And that's the most important number anyway. So all is not lost. But sometimes you need to report the test statistic, then you have to calculate it by hand unless you're using SPSS or SAS or R or some other statistical software, okay? So Excel tends to be very bare bones. You can use the dialog box. I don't. That's a personal preference. And the way you get, I'll show you both when I go to the Excel, but let's kind of do the problem. I'm going to go to, well, actually, let's first focus on the question, because this is really important. I want you to understand the distinction here, okay? The question is, do males and females differ in their job satisfaction? Okay, so what we did is we gave males and females at a certain company a scale and said, how satisfied are you with your job? Or some measure like that. And the higher the number, the more satisfied you are. So, you know, if I kind of eyeball the data, you can see that males seem to be less satisfied because there are 2s and 3s and a few 4s, but females are 4s, 5s, and 6s and 7s. So before I even do the analysis, I have a hunch that females are more satisfied. But the question is there just a difference in the satisfaction? Okay, because in a second, what I'm going to do is, not in a second, right now, I'm going to flip the question and ask the question, are females more satisfied with their jobs than males? That's a different question. Statistically, you find that answer differently because now we have a directional hypothesis. Remember, directional means we specify which one we think is higher than the other or lower than the other. Whereas with this question, we just want to know if there's a difference. So that's all going to matter when we go to the Excel, which we're going to do right now. So here we go. All right, new share, Excel, and I'm going to go to chapter 11. So it's the same data that you're seeing in the slides. And I've labeled it unequal or equal, so we know what to expect. And I'm going to show you how it shows up on Excel. But also notice, again, 2 groups. This is why we were able to use a t-test, because we have males and females, and they can't be the same people. They have to be 2 separate groups with 2 separate sets of people. So I tell Excel, let's do a t-test. So t.test, open parenthesis. And by the way, I said to you, I'd also show you how to do the dialog box if you want to do that. There, what you do is you go to insert, formulas, and then it gives you functions. It's, you know, it might be arranged this way where you go to statistical, and then you go down to t-test. So you have all the functions here that you might want to use. And you'll see it brings up this dialog box. Again, I don't necessarily like using these because I think it's just easier to work with the parentheses. But if you want to use it, it's the same thing. It asks for the same data. Okay, but let's do it my preferred way. Equals t-test, open parenthesis. It's asking for array 1, which is here. It's asking for array 2, which I have to separate with a comma, so I drag over the females now. The next thing it asks for is tails. Really important, okay? The question is, are you trying to answer the question of just plain difference, or are you trying to answer the question of, is one group higher than the other or lower than the other? The question on the last slide was, do male and females differ in their satisfaction? If it's just a differ, then that means you have a 2-tailed test. So the number you put in for tails is literally 2. Too many commas there. So I'm putting in 2 for tails. And then I have one more parameter I have to enter, separated by a comma. It's giving me a choice of paired, 2-sample equal variance, 2-sample unequal variance. For sure, it's not paired, because that means you have a dependent samples test, and that's the next topic of discussion. So you would never choose 1 in this situation. It's a choice between 2 and 3. And this comes back to the issue we talked about before, which was, are the variances the same or different across the 2 samples? Okay, for the time being, I'm going to go ahead and choose 2 and say that they're the same, homoscedasticity. So now I'm done. I, again, got too many commas in there, so let me get that one out. And look what we get back, some very, very, very tiny number. That's the p-value, okay? And it's way below 0.05. It's basically almost 0. When you see this e to the negative 10th, that means e to any power means you have a tiny, tiny number, certainly less than 0.05, because it's like 7.7 and go back on the decimal place 10 paces, and that's the number, okay? So let me do the same for the other group. Equals t-test, open parenthesis, drag my, oh, I'm sorry, no, I don't have to do that. What am I talking about? We already did it. You did it because you dragged across 2 arrays of data. Sorry, my mistake. I was thinking we had 2 z-tests. Okay, so now what we want to do is the case over here where the means are unequal, or sorry, are equal. Here are the cases where the means were unequal. Now we're going to look at equal means across males and females and see what kind of result we get. So equals t-dot test, open parenthesis, get my male data in for array 1, get my female data in for array 2. Tails, again, it's the same question. Do we have a difference in means? So it's a 2-tailed test, comma, and then it asks for the type, which is, and for some reason it's not coming up as a list until I delete, but we're going to assume again equal variances across samples. So I'll put in another 2 there, close parentheses, and let's see what we get. So there you get a much bigger number. I'm going to give this guy a haircut. So it's, 0.27. What's the line of demarcation? 0.05. If you have 0.5 or less, you have differences. If you have greater than 0.5, it's the same. Okay, so this 0.27 is basically saying the means here are the same. And the thing that we forgot to do, I should have done it before, let me do it now, is let's actually calculate the means, and let's calculate the variances. So mean, variance, let's move this over to the left, and let's do an average here. And I don't need to close parentheses. Let's give this guy a haircut. And let's do a variance here, equals variance. And sorry, you should have done this first. This should have been your first step, but sometimes I forget. So we're calculating a variance there. Oops, didn't want to do that. Oh, it's var, sorry. VAR, and we'll do sample. Okay, so that's that. And let's make that even shorter. And then I'm just going to copy these formulas over to here. It'll do the same thing for that. And then I'm going to copy this formula over to this group. Do the same thing here. Okay, so first thing is, okay, the means definitely, if you eyeball it, definitely look unequal here. The means look more or less the same here. They're pretty close to each other, okay? The variances, you have 0.6 and 1.5. I don't know, those variances might actually wind up being different because you figure that's about a full point difference on a 1 to 5 scale. So 1 point difference on a 1 to 5 scale is pretty significant, okay? Where we're not seeing as much heterogeneity of variances in this sample. The variances are much closer to each other. So when I'm doing that t-test, I might want to switch to, if I go back to this parameter, this parameter, which asks me about the type, and let's pull up the choices again. If I leave it blank, I get the choices. Now I'm going to switch to 3. Let's call this one a 3, which is the variances are unequal, heteroscedastic. And lo and behold, the result basically doesn't change. Okay, but I still did my homework. I tested the scenario, and I'm still getting a number way below 0.5. So again, it doesn't matter a lot of the time whether you choose a 2 or a 3 there, because the tests are, what we say is in statistics, the tests are robust to those differences. In this one, I bet you it's going to be the same result. Let's just see. We're going to change this 2 to a 3, which means unequal variance, and basically didn't change at all. Okay? So sometimes it matters, sometimes it doesn't. Most of the time, it doesn't matter which one you choose, unless the variances are really whacked out and very, very different. Okay? But you don't know till you test sometimes, and sometimes you have to do that before you can be sure, if it's not obvious. Okay. So that's the first question. Now, the second question I want to ask is, and this is all on the slides, but I'm not going to go back to the slides. I'm going to delete these. The second question I want to ask and answer is, are female satisfaction scores higher than male satisfaction scores? Or you could flip it and say, are male satisfaction scores lower than female satisfaction scores? So how do I do that test on Excel? Well, it's basically the same process with one little change. So here we go. Equals T dot test, open parentheses, drag your data. Let's deal with the unequal mean scenario first. Get the females in there as well as the males. Now, here comes the point of distinction. It's asking me for tails. It's going to be a one-tail distribution if there's directionality in my hypothesis. I'm saying I think females are higher. And, you know, look at the means, right? Males 2.7, females 5.1. So it's, by eyeballing it, you would probably be making the right guess. But I have to specify a one-tail test for Excel. And then, again, we learned before that variance type doesn't matter. So I'm just going to put it in a 2 and be done with it. So what do I get? Again, a tiny, tiny, tiny little number, less than 0.5 for sure. Again, when you have less than 0.5, what does that mean? Significant differences or significance. Same thing. That means females are higher than males. And how do I know? Just by looking at the means. Because females are at 5.1, males are at 2.7. So I put 2 and 2 together and I can say females are statistically higher than males in satisfaction scores. But again, you couldn't draw that conclusion until you did that test that we just did. Let's do it over here. Same deal. Equals t-test. Again, what are we expecting? The means are pretty close to each other, so we're expecting to not get a significant result. But let's just do the work. Array 1, array 2. How many tails? One tail, because the hypothesis is that females are higher than males. Type, we're going to put in a 2 and just not worry about it. And okay, so now we get a lower number than we got before, which was 0.27 if you remember the result, but it's still higher than 0.5, which means there's no difference in the means. So this 5.0 is the same as this 5.3, statistically speaking, even though they're different numbers. Okay, so we cannot conclude that females are more satisfied than males in these two samples. We can't conclude it. Alternatively, we can say there's equal satisfaction among the genders in this company if we believe the sample is representative. Okay, so that is what I just did for the next couple of slides. Let me go back to the slides. So we basically just did this. We did this, this, and we are now going to talk about a different concept called effect size. As I said, I think last week, statisticians are relying less and less on p-values to determine whether we have differences in quantities. Because let's say you've got a 4.0 and a 4.1, and they're statistically different, but the meaningfulness of that difference is very small. Okay, so sometimes what I want to know instead is, are we talking about a big difference or a small difference or an in-between difference? P-values don't tell you that. Test statistics don't tell you that. A measure called effect size is exactly what it sounds like. It tells you the size of the effect. How different are the groups from one another? You can only use effect size on independent samples. Okay, which again means you have different people in each group or different objects in each group. So it's restricted to that. Make sure you understand that. And also understand, again, this is becoming a much more widely accepted measure of statistical results. Here is the formula. It's pretty simple. You're looking at the difference in means, just like you did for the t-statistic, but the difference is in the denominator where you're using what's called a pooled variance term. And again, if you relate this back to the formula we use for the t-statistic, this will look different. It's much simpler, actually. But you don't even have to worry about it because we have a way to calculate it using a website, of all things. And what I want you to focus on is these results, okay? Small, medium, and large. It's kind of like ordering fries at McDonald's, okay? If you have an effect size that's between these two sizes, then you have a small effect. If you have an effect size between 0.2 and 0.5, it's medium. If it's larger than 0.5, it's a large effect size. That's the convention, that's the standard that statisticians use. So how do I do this? You can actually go to a website. I'll do this. Actually, I think I went to the website before. Let me get back there. If I can find it quickly. If I can't, then we'll just talk about it. Well, let me do some copy and pasting here. So I'm going to take this. Somebody was nice enough to make this website, and I'm going to put it in my browser. Which you can't see yet. And so now hopefully I should be able to share that screen. And I think that's it. Yeah, okay. Okay, so we see the effect size screen, browser, yep. All right, so what you do basically is you put in the mean of group 1 here, you put in the mean of group 2 here, which you get off Excel, we just did that. You can find the standard, or you have the standard deviation of group 1, you have the standard deviation of group 2, which we just did on Excel. We did variance, but you can just do standard deviation instead. And you hit compute, and it'll return a Cohen's d down here. Okay, so if I go back to the one that we have in the slides, you will see those numbers filled in. So let me get back to the slides here. And so there it is. It's the same thing. And the result that we got was a 0.383 for whatever data set led us to that result. And so what do we have? We'll go back to the scale. It's between 0.2 and 0.5. So it's a medium effect. Okay, it's not hugely different, but it's not a small difference either based on this effect size calculation. All right, so just know that that's out there. That's an alternate technique that you might want to use, and it's gaining in popularity. And with that, it will take us to the last topic of the night, which is the flip side of the independent t-test. Now we're going to talk about the dependent t-test. So again, if you like using this chart, great. If you don't, no problem. But I skipped down to the punchline. We're dealing with 2 groups. And the question up here says, are the same participants being tested more than once? And if the answer is yes, then you need to use a t-test for dependent samples. Okay, so think about, the best example I can give you is training, right? You have employees, they come in, they don't have the skills. So John, Ginger, and Larry, let's just say we have 3 employees. Now we train them, and we give them the same test again later to see if their skills improve. But it's still John, Ginger, and Larry. Okay, I don't know where I come up with those names, but my point is, you're not switching people across the 2 phases of study. It's the same people being reused with 2 measures. And that's what distinguishes the dependent samples t-test from the independent samples t-test. Remember, independent samples, girls versus boys, males, females, can't be the same people, okay? And it's the same end result. We're trying to figure out, are there differences in the pre-post in the 2 observations? And are they significant? Did it go up? Did it go down? Did it stay the same? So here's your formula. It deals a lot with these d's. Some of these squareds, those are differences, right? Larry started out with a 50%, and then he got training. Now he's at 90%. So that's a 40% difference. That's what we mean by difference. So again, the most important thing as far as the process is knowing when to use that dependent samples t-statistic, which we just told you. Degrees of freedom for this test are simpler than for the independent samples. It's just how many differences you have minus 1. Okay, so, or how many people you have in your sample minus 1. So in our sample, we had 3 employees, subtract 1, your degrees of freedom are 2. Again, what's a degree of freedom? It's basically an approximation of sample size. Okay, but it's not quite sample size because it gets a little bit more complicated with these tests. The way you interpret these t-tests is exactly the same way you interpret the independent samples t-test. So nothing changes. Just to use a brief example again that I used before, when we had the P of 0.27, that means we have statistically similar results across the two groups. Okay, same thing here. When we had a P of 0.02, that means because it's less than 0.05, it means we have significant differences. So like the pre is different than the post, or the post is different than the pre. Either way you want to look at it, if I use that example. We already talked about when you use a one-tailed test versus a two-tailed test. So here it is again in a slide. But the question is, do you have a directionality in your hypothesis? If you do, you're saying one group is higher than the other or lower than the other, then it's a one-tailed test. If you're saying, I just want to look for differences, I don't know which one is higher or lower, then it's a two-tailed test. Where does it matter? On the Excel. You have to tell Excel how many tails to use, so you have to know whether you have a directional or non-directional hypothesis. Okay. So the mechanics of it all are the exact same, except for that one difference I mentioned. So let's go right to the data. Here we have an employee, so it's kind of the same thing I was talking about before. We want to see how employees do with the training. So here's how they do before the training. They have these test scores. And then we train them. We want to see if post-training they did any better, okay? So I'm going to show you an equal means scenario where they didn't do any better. I'm going to show you an unequal situation. So let's go to the Excel. But the main questions are, did we see any differences? I'm framing that question in terms of, did employee skills change? The keyword there is change with the training. Up or down, I don't know. Doesn't matter in this case. Or the opposite case is, let's go to the slide here. I'm skipping down slides. Did employee skills improve with training? So the change is going to be the two-tailed test. The improve is going to be a one-tailed test. Okay, letting the cat out of the bag there a little bit early. But let's go to the Excel. Okay, so now I'm in Excel. And I'm going to go to chapter, by the way, there's this tab in your Excel, chapter 11 t-test says no. I should have deleted that out of the Excel, but I didn't get a chance to. So just skip it. It's not relevant, it's wrong. And go right to chapter 12. And you see the same data that the slides showed you. So let's do the process again. Now, the thing that you want to ignore actually is the employee number. The only reason I put it there is to demonstrate to you that, for instance, we look at employee number 1. This is the same employee. At first, he or she got a 38, then got trained, then got a 43. Employee number 3, first he or she got a 90, then got a 60. Not good. But these are the same people. And that's why you're doing an dependent sample t-test, dependent samples. That's how it looks. And you'll notice you have to have the same size of the group in both cases, okay? Whereas in the independent sample, I could have had a group this big, and then I could have had a group this small. You can have different sizes with independent sample t-test. You can't have different size groups or sample sizes with dependent sample t-test. Okay, so getting down to the business of doing the t-test equals t.test. Nothing changed there, still same function, open parentheses. Don't drag the employee number, it's not relevant. We just want to know the pre-training scores, and then we want to input the post-training scores, comma, tails. If we're asking the question, did the scores change, or is there a difference in scores generically, non-directionally, it's going to be a two-tailed test. Okay, and then it asks us for type. I'm just going to put in heterogeneity of variances. I'm not going to worry about it because, again, most of the time the result doesn't change. And so there you go. 0.26. Is that below 0.05? No, it's well above 0.05, which means that we have statistical similarity, no differences. And that's what we expect because this is the equal means study. I rigged it that way. So what's the conclusion then? The scores are not different between pre-training and post-training. And let's calculate a quick mean. just to kind of see that this test is telling us the right thing. Drag the formula over here. And yeah, so those numbers are pretty close. 60, almost 70 versus 63. Okay, but Excel is confirming these numbers are the same, even though they're different. That's the whole point of statistics, right? We're not done until statistics tells us we're done. Okay, so now going over here, let's do the same thing. First, I'm going to calculate a mean. Actually, I should have always done that first, but I didn't. And I'm going to drag this formula over. And we got a mean here, we got a mean here. Whoa, look at the difference. Basically 40 versus 61. So of course these are unequal means, but we have to have statistics confirm that. So we do the t-test. First array, second array. Number of tails, again, the question is, did we see any changes in scores? So that's a two-tail test. And I'm just gonna call it a 2 for heterogeneity of variance. Click through, and yeah, again, you get one of those tiny little numbers, way less than 0.5. Again, anytime you get that E, it's definitely less than 0.5. And that's what we would expect in an unequal means study. And the means are definitely unequal. Can I necessarily say that post-training is higher than pre-training? Yeah, actually I can, because this is a statement of inequality, and when you calculate the means, obviously this one is higher than that one. So you could actually make that leap, but the technically correct way to make that leap is you redo everything. Let's get rid of these tests now, and do a test that shows us whether we had improvement from pre-training to post-training. So that's, again, t-test. Same arrays, array 1, array 2. Now, because we're asking the question, did the scores improve from pre to post training, we have to do a one-tailed test. And I'm going to keep the type as 2, simple. And I get a 0.13. So again, the rule is greater than 0.5. Yes, that's what we have. Means no significant differences. So scores did not improve between pre-training and post-training. Okay, statistically speaking. Over here, let's do the same job, t-test. Open parenthesis, pre-training data, post-training data. Again, did the scores improve, which means that there's directionality, one-tail test, and then we're going to call it a 2 for homogeneity. And again, you get a tiny little number, not surprising. Of course, this one's higher than this one, but now we have confirmation statistically, okay, because we're much less than 0.5. So that's it. That's pretty much all I want to tell you on the t-tests. And everything you see back in the slides goes through the whole process, and it just kind of diagrams it for you. So I'm not going to go back to the slides and talk about that because we just did it all on Excel. So let me stop the sharing here and then just, no, actually, let me bring it back to, I wanted to get it back to Moodle because I want to talk about that quickly. And of course, there's so many files here, I can't seem to find my Moodle. Well, who's got the last 2 comments? There's 1 or 2 of you left, right? So who would that be? Who's ready to go?
I'll go.
Go ahead.
Mine was a quick question. I think earlier when we were talking about the net exports, you had mentioned that it would be better to have more imports than exports, I think. Did I hear that right?
Yes. Well, so that's your question. Is it really better to have more imports?
Yeah, because I always just assumed it was better to have exports.
Yeah, so there's 2 schools of thought on that. But again, what you find most of the time is that the more advanced economies have a net, the number is negative, which means there's more imports than exports. And the reason why that's seen as beneficial is because it means you have the financial wherewithal to basically do the importing. Okay, so you can afford to buy all of this stuff. But you know, the flip side of it is think about a country like kind of a landlocked. I'm sure there's some countries out there that have to import everything, you know, because they just can't make a lot of things. They don't have a lot of resources, and they're not doing well. So there's two schools of thought about some countries that can choose to import, and those are the ones that benefit from it, versus the ones that have to import because they have nothing. And in that case, the logic doesn't fly, that importing is better than exporting, if that makes sense.
Oh, so when it's a choice to import, then that's when it's beneficial.
You got it.
Oh.
Who else?
I can go.
Go ahead.
Okay, so I know that like when companies or institutions, like when they do research, they have to go through some kind of review board. Under what conditions do the review boards, do they become more like strict with regard to like studying consumer behavior? Because you see a lot of companies doing a lot of research. Like I know, like for example, with psychology, they would be more strict with regard to more vulnerable populations, like children or incarcerated individuals or whatever that may be. But like, what is it for business? Like, when do they become more strict with regard to their requirements? Like, obviously, like manipulation or deceit, they would be, but like, are there other criterias or conditions?
So who's doing the testing here? Who are we talking about? The government or academic institution?
I guess like academic, maybe. That would just be easier.
Yeah. And so your question is, if we're testing businesses as opposed to people, are there different requirements from IRB?
Yeah, like if they're studying consumer behavior, but like, are there certain conditions where the IRB would be more strict?
I don't know. Anybody know? I never ran into that issue because I always test. When I did my research, I used people, not businesses. But you know, businesses are made up of people, so I don't know that there would be any difference. But part of what complicates the answer to that question is that different schools have different policies, right? So we're talking about academics doing studies. Berkeley's not going to be the same as Santa Clara in their procedures. So, but you would think theoretically that you have less to lose when you're testing businesses. So I don't think the requirements would be as stringent, but I could be, I don't know. I don't have a good answer for you. It's a really interesting question. I don't know because I've never run into it.
Okay.
But then again, you don't bring a business in as a subject. You know, when you're analyzing business data, usually you're getting it from some report. So I don't think there's any IRB requirement in that case because you're just analyzing secondary data.
What if it's like businesses with people, like they're studying consumer behavior?
Right. So in that case, probably the same standards would be upheld, whether you're talking about individuals or businesses. I don't think there would be any change in the theoretically, again, depends on the IRB department that you're dealing with, but I can't think of a reason why you would have different standards if you're talking about people's data. The end result is people's data being exposed in the wrong places. So why would you change your standards? I don't think you would.
Okay.
Now, you know, there might be more checkups on businesses because it's harder to, you know, regulate what they wind up doing with the data. So, you know, in that respect, maybe they'll ask some more probing questions about how the data gets dealt with, because, you know, we have this whole thing on privacy on the internet, right? Businesses use all this data that they collect on us and we don't like it half the time. So that's a good point. You know, there might be, now that I think about it, maybe there are more stringent standards, but I don't have a good answer to your question because I don't do those kinds of studies.
Okay.
Anybody know? It's a really interesting question. Okay, well.
Yes, I have a question.
Please.
Yeah, actually, there is a question going on my mind a lot recently, and maybe sharing our opinions can help us to understand and clarify what is going on. The question is, does anyone has a doubt that that is what going through now is a biologic war? Or nobody think about that?
Are you saying the pandemic's a biological war?
Yeah, the virus now, what we are facing now, it's look like the biological war.
I actually have, read there's a bunch of stuff in the media, but there have been some rumors that apparently this was kind of like a weapon at one point, and that it got leaked out of the lab. So I don't know. It hasn't been confirmed, but I've heard this before. Yeah.
I've heard that theory. It's like a conspiracy theory. I don't buy it because it originated in China. Let's all agree that's the case. So the Chinese want to hurt their own people at the same time that they hurt us? That wouldn't make any sense.
Yeah, but the China itself imprisoned the doctor who's warned about this virus, right?
Yeah, right.
Yeah, and that's seem strange.
Yeah, I mean, I think it's just more they wanted to cover up the fact that they were even having the virus, because it makes them look weak economically, and who wants to be blamed for starting a virus? That's the other thing, right? A lot of anger against China now because they're the initiator. So I don't take it to the level that this is biological warfare, and but what do I know? I wasn't there, so it's anybody's question, or it's any answer could do here. I don't know. It's hard to prove either way.
Yeah, it's hard now to prove, but maybe the days will give us the answer, the correct answer.
We will see.
Yeah. Thank you.
Yeah, great question. Did we get everybody?
No, I'm still missing. When we got started, one of the things that I found really interesting was the chapter about unemployment. But as you were going through the different things, I found it really interesting that you talked about that country that doesn't do the GDP, but it does it based on happiness. And it got me to thinking, I wonder if the US ever thought about it that way, or would ever consider it that way, because there's so many other countries who are productive and have a good economy, maybe not as strong as the US, but their employees are given so much more benefits. Like I remember still to date talking to my family members in Mexico, their lunch hours are anywhere between 1 hour to 2, right? And they're very productive, and they have very good healthy careers, and they're financially stable, and even the students, you get to choose to go to school in the morning or get to school in the afternoon. A lot of people don't want to wake up early, and so they're more productive in the afternoon, so they go to the afternoon sessions. And other people are super up and going at 7 a.m. in the morning, so they go in the morning. And it seems their economy is not the strongest, at least not compared to ours, but their people certainly seem to be happier. They're not as stressed, they're not as heavily medicated on some type of medication to control their depression or their stress or their lack of sleep or whatever they have going on, in comparison to a lot of our people here. I know at least where I work, there's about 16 females, and I want to say at least 10 of them are antidepressants or some sort of medication because they're so stressed out.
Yeah, it's really sad. And it comes back to my original point and the points that we were all making tonight, which is we value productivity and work more than we do lifestyle and health. It's a problem. Now, again, I don't know if the pandemic's going to change anything. Maybe it will. But on the issue you brought up about the schools, there's been studies done that show starting school too early for school children has negative effects. You're better off starting the day at least at 10 o'clock. Students do better that way. But what you said takes it to a whole new level, which is now you can choose afternoon versus morning. That's even better, probably. But yeah, and then we're over-drugged, we're over-medicated because we want a quick fix and we want to get back to work as soon as possible. And the right thing to do is, if you're having a bad day, take the day off. Go take a nap, go get a massage, go swim, whatever you do to get the de-stress. Don't take the pill, because the pill will solve the problem immediately, but it's going to create the longer-term problem if you're going to become less and less healthy over time. And of course, the pharmaceutical industry doesn't want you to think that way. So I would love to see the adoption of every single thing you talked about in this country. What's it going to depend on? You know, do we head more towards, if you have socialism, I think that you have better conditions for that. Liberal politicians, I think, but that's not the whole thing. Republicans in office, forget it. It'll always be a grind, I think. So I think it starts there. And I also think people need to start demanding it and kind of fighting back against this crazy machine that we're made to be all the time. But what do you guys think? It's a really cool topic that I love to talk about.
On that same note, I know we were talking earlier about more divorce going on right now, but personally, I've been enjoying a lot of great family time because I have 2 older daughters that are going to college and 2 working parents, but we never really get to see each other because of our crazy calendars. But yet with this, we've gotten the chance to, when homework's done, when work is done, we spend a little bit more time together and not necessarily running around to go to the next thing. So I think you could see that as well. I think that there's a lot of positives and a lot of people are going to spend more family time.
That is very true. My job is actually very demanding, stressfully. Like there's a lot going on, and my fiance, same. And we would come back from work to our regular dinners or whatever, and we were just so exhausted of the whole day that we were just having just dumb discussions and nothing serious, but there was some kind of tension always. But now that we've been home, it's actually been really nice, and we've actually had really nice quality time, though we're still working or doing our everyday things. Like right now he's right in front of me doing his own thing, so that's kind of nice, I must say. So there has been some positive things to this for sure.
Yeah, and again, I come back to France. Mm-hmm. France, for the longest time, half the people there are unemployed. What do? They sit at cafes all day and drink, right? And I think that's nice. If your economy can afford to support people, because France is basically a socialist economy, still, even to this day and age, that can support people not having to work all the time, or when they do work, they work 35-hour weeks, which is much more reasonable than what the average American does. So. That's why I supported Sanders. I wanted him to win. I thought maybe we would become more like Europe, France. And then he wound up losing, but I think, I don't know. I think it's a tough sell. A lot of us want it, but we're not willing to actually fight the fight to get it. I think it's a problem.
I agree. I have a quick comment to make. I feel like a lot of changes that we want to see happen, especially in the wake of this whole pandemic, we've seen a lot of changes. We can be productive. There's a lot of different things that we can do to improve society as a whole. And I think, like you said, we have to demand it. It's not like, the big bosses up there are going to be like, oh, I think this is better for them. Let's do this. This is nice. They're not going to do that. So I feel like, especially with social media, I know she was talking about depression and all that stuff. And I feel like the conversation around mental health has been a lot more louder nowadays, especially with social media, and also the Me Too movement that was happening. And I think that started because of social media. And I feel like social media in general has has evened out the playing ground when it comes to voicing our opinions. And I feel like if we want to see change and moving forward, and we don't want to go back to the old way of doing things or going back to normal, and we want to implement any and every good thing that we've experienced through this pandemic, I feel like we have to demand it, and we have to voice our opinions, whether it be through social media or whatever the case may be. But it's just something we have to fight for. It's not just going to happen. And I was rooting for Sanders too, so that went down the hill, but it is what it is.
Yep.
Yeah.
Sorry.
Sorry.
Yeah, everything you said, I agree. Got to fight for it. And maybe the pandemic will change things. Maybe. I'm hoping, fingers crossed, but we're going to see. We'll have to wait and see.
I mean, they've also I've seen the air quality. They've said in certain areas the air quality got better too. And it just makes me kind of think like also with regard to this whole pandemic, if part of it's related to issues related to global warming.
Yeah, I
I
think
think
so
it
too.
is.
Earlier we were talking about the traffic and how we're not driving and all that stuff, and I think that goes to production also, like China being like, you know, the biggest manufacturing country, and now they're pretty much on a lockdown, so they're not producing as much. The world as a whole is not consuming as much, and I'm sure that's having like an effect on the economy. But if we're more conscious about the way we spend our money, the things that we buy, I think I was talking about this maybe the first week too, like where we're just constantly buying things just because it's been thrown at us. So if we're more conscious of the things that we're willing to buy, maybe they won't make it.
Yeah, no, I think you're going to see a paradigm shift on what's, you know, if this thing persists.
Yeah.
What's really important, because we buy a lot of stupid things that we don't need to buy. It's really true.
I must say, this whole pandemic thing has been a good saver for my wallet.
Me too.
I'm not going out as much or buying things as much, and definitely focusing my finances on things that I need, as opposed to things that I want.
I saw a post on social media earlier that said how our money is not going to gas, it's not going to like all these like random things that we spend money on, it's all going to grocery nowadays.
Yeah, and I used to be really bad at just being bored and sitting down there and just going on Amazon and buying things that, oh, this could be useful, but maybe if I ever use it, you know. But now I'm like, I don't know. I'm staying away from that. And we're not going out, which also helps my wallet a lot. So I've seen that shift already. I've also seen a shift through social media that all of a sudden everybody's becoming active and working out at home, which is something that before I don't think people thought of much. You know, it was just you go to the gym and work out. And now I see a lot of like, you know, the 10 push-up challenge, or, you know, do squat challenge, or all this stuff that is coming up that I already see that change too, and maybe can entice a healthier lifestyle for everyone as a good reminder after all this is over to continue that.
I think if you can manage the anxiety part and the, you know, people are getting at each other's throats, so there's more fighting too, but all the other positive you talked about, the fact that we don't have to waste part of our day commuting, we don't have to spend on stupid things like gas, could very much help, and then the environment gets better. There's a lot of positives that can come out of this. Absolutely.
Yeah.
Totally agree. Okay, well, way past our bedtimes here. Anything else we want to discuss? So I just want to, I can't seem to find Moodle on my screen, but you're basically ready to do the first part of the macroeconomics, and then Z-tests and T-tests for the statistics part. There is no, just so you know, I don't know why this happened this way, there is no questions on economic growth in the macroeconomic section. It's just gross domestic product. So if you're searching for that and not finding it, you're not crazy. It's just not there. And I don't know why it's not there, and I won't stick you with it either. So we'll leave it at that. Other than that, I am done talking. So I will see you next time. Same time, same place. Have a great week. Stay well, stay strong, and let's get that political movement going, okay? So we can all have a better life. All right? Okay. Bye.
Thank you, Jordan. Good night.
Thank you.
Hey, Jordan, can you let me know how the discussion goes with Reem?
Yes.
Okay.
All right.
Thank you.
Question for everyone. Did anyone hear back from Sina?
I did.
You did?
I did. She actually, I just talked to her today, and she explained that she's really backed up in emails from the announcement that they're closing the school next year. But she's slowly getting through everybody. So she will eventually get to you.
Okay.
Just as a way of comforting. You know, I waited for like a week and a half. I'm like, oh, fine.
Yeah.
And by the way, on that note, we just changed summer schedule. We added more courses. So, and obviously everything's online. So it's so you'll have more possibilities to get this done. What you want to do, my 2 cents on this whole thing is just finish with us, and we'll get everybody through that wants to get through with us. If you're dead set on transferring, that's fine too, but it's your choice. But it's just easier to get done with us because you have all the setup that you need already. When you start transferring, it's that you're gonna get, you know, you have to take this and you didn't take that, and it's all that kind of big mess. So,
Jordan, with the summer classes being online, will many of them be taught in this format, or will they be more of the, here's a syllabus, go do it?
it's about a 50-50 split. And the reason for that is For those who want to double up, we want to have the option of having the asynchronous. So that means you can. So it depends on the course, it depends on the instructor. But
how will we know?
Mix. How will you know? That's a great question. You will know the courses that are. I can tell you. I can literally send you a list. I'm trying to think how it's going to show on Portal because I don't deal with that. That's Jane's job.
Yeah, because I looked earlier today and happened to see that there were some classes and some had like a date that they were being done, but a lot of them were just TBD for everything. The instructor, the courses, everything. Right.
So that's it. If you see a day for the course that's not, when we do for an online course that's asynchronous, it's Monday 8 a.m. or something like that. It's this ridiculous time that nobody would ever show up. We do that purposely to signify that it's a asynchronous class. If it's a day, like a Tuesday, Wednesday, 6 to 10, 15 p.m., then that's going to be a synchronous online class like we have now.
Okay. Yeah, if you know which ones are going to be done which way, if you could send that out, that'd be great.
I'll send that out anyway. And then I'm going to also ask Jane if she can list it a little differently now that we have this distinction. So I'm going to see if I can even get that on Portal too. But barring that happening, I'll get the distinction list out to you. All the Tracy folks, which I guess would be everybody here pretty much, very, very soon.
Okay.
Very,
yeah, because I know the people in the other class are wondering also.
Yeah. Again, it's about a 50-50 split, maybe 55-45, leaning a little bit towards the asynchronous because we want to give people a chance to double up. And you can't double up if you have a class on the same night, 2 classes.
Right.
Yeah.
Well, that's why like this semester having the Monday and Wednesday, it worked.
Yeah.
So.
Yeah. Right. If you
the
luck
Wednesday
out,
would
the
have
days are different. If you luck out, yeah. Sometimes they're not different days.
Yeah.
In the business, I'm looking at the business ones for summer. It looks like there's only 3 of them that list like a specific day. The rest of them are just to be announced online instruction.